9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a very busy Thursday ahead of us. The Nvidia-fueled AI rally is pushing futures higher this morning, igniting a global rally in tech stocks. Wall Street cheering the chip maker's fourth quarter earnings beats and demand for its data center chips. Semis rallying on those quarter results. We're going to dig into how big this AI boom can get.
So we've got equities rallying in the pre-market, but we also want to take a look at the action in the bond market because yields pushing higher after minutes from the latest Fed meeting signal that the central bank is in no rush to cut rates. Now traders are pushing out their bets on when policy officials are going to pivot. So let's get right to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Dan Howley, Jared Blickery, and Madison Mills have more.
Stock futures rallying on Nvidia's earnings beat. CEO Jensen Huang saying generative AI has, quote, hit the tipping point after reporting a 265% jump in revenue from the prior year. Nvidia also laying out upbeat guidance for Q1, signaling its AI hardware demand is booming. Despite the company's big win, though, there were some signs of weakness as data center revenue out of China fell significantly in Q4 due to U.S. licensing requirements.
And with futures moving on Nvidia's big earnings win, assessment of the Fed's next move appears to be on the back burner. The central bank's latest minutes, they're showing officials, most of them, are looking to tread carefully on cutting rates too soon as they look for convincing evidence that inflation is returning to that 2% target.
And Moderna's shares are jumping in the fourth quarter. That is due to a surprise beat in profits despite a slump in COVID-19 vaccine sales. And Moderna reiterating their full year 2024 sales guidance of roughly $4 billion.
Well, good morning, everyone. Getting to our top story of the day. Stock futures rallying this morning on Nvidia's big earnings win. Shares of the chip maker, they are rising here in pre-market after beating analyst expectations on both the top and bottom line in the fourth quarter. Nvidia issuing strong guidance, we do know, for the fourth quarter, anticipating a $24 billion in revenue versus around the $22 billion that was estimated. We're also seeing the results play out in the markets this morning, rallying chip stocks here. So what's ahead for the AI-fueled rally? We are now joined at the desk by Yahoo Finance's Dan Howley and Josh Schaefer here. We got to dive into these results. Dan, you kind of teed up the conversation from what we saw within these results, and you've been tracking exactly how this company has been meeting some of that demand for generative AI as well.
Yeah, I mean, look, they knocked it out of the park. I mean, they were results that, at first, I think people were slightly disappointed because you saw the stock fall slightly right after the announcement. And then it obviously picked up, and now it's almost up 12% so far. So obviously people very excited. I think a few key takeaways to point to, and one that I'm looking at in particular is sovereign AI is something that Jensen Huang, the CEO, had brought up a few times. And that's basically the idea that every country needs their own AI capability. His thinking is, look, outside of the broader issue of, U.S., China, do they want to have their own AIs? He says it's more of a cultural thing. Companies want to be able to include their own language and their own, ways of thinking inside their own AIs. And so more countries are going to be pulling in these kind of capabilities and start to launch these in the future. So I think that's something that's worth looking out for. And then, we pointed out the slowdown in China revenue for Q4, just dropping off a cliff, essentially, is what they're saying, because of those licensing requirements from the U.S. It was something that they had said wouldn't impact them as far as revenue goes in the past, and clearly that's the same now. But the big issue for NVIDIA is what are they missing out on then? And that's something that they've called out in the past as well.
Dan, it's so interesting because any of that weakness, it seems like investors are just looking past right now, and analysts too. When you take a look, what is it, 90%, I believe, of analysts have a buy rating on NVIDIA. A long list of analysts up their price target here. But Josh, what do you put this in perspective for our viewers, just in terms of the importance of NVIDIA to the broader market and the fact that we are seeing so much excitement from this beat that we saw last night, really what that signals maybe about some of those future gains that we could see?
Yeah, I think to understand what it means for the broader market, you can just take a look at futures today, right? You're seeing stocks higher, significantly higher. You look at the futures on the Nasdaq 100 up about 2% right now. That is a significant move, and that's driven by Nvidia and also the other stocks that it moves with it. And one thing I was thinking about as Dan was sort of going through some of those key numbers is just how important it was for Nvidia to hit its marks. Because analysts expected revenue to jump by a significant amount. They expected earnings to jump by a significant amount, margins to jump by a significant amount. But that was the main driver of what analysts expected for the broad S&P 500. Nvidia was the biggest contributor, according to FactSet, for what analysts were expecting for revenue in the tech sector. And the tech sector is the best performing sector, right? And I was thinking about this chart actually that Goldman Sachs had highlighted recently when they raised their target for the S&P 500. You can see here, we're looking just at info, tech, and comm services, the margins and the growth there essentially leading the way for the S&P 500. If you remove info, tech, and comm services, you can see margin growth would actually be lower than what it's expected to be for the overall S&P 500. So to me, that's not just Nvidia, but it's the other companies that are also leveraging AI, right? And this AI story being intact, how important that is for the market.
Yeah, I think one of the things to point out is, this is like the foundation when it comes to AI, right? So we have the whole AI ecosystem. It's two things. It's hardware and software. And so this hardware that we're seeing sold then has to mean software getting built and being used. So you can take this as kind of a litmus test for, the demand for the AI is there from the companies, right? They want to be able to build out their AI. Now it's up to the software vendors, and we saw some of this with Microsoft, to say, okay, there's also demand from our customers for this AI. So it's going to be a continuing kind of timeline as to are we going to see that demand from the software vendors, from consumers continue to rise. And Microsoft had said 6% revenue jump for Azure from AI. Google not really giving us much insight into that. It's part of the Google Cloud. Amazon doesn't really break out how AI does for AWS. It's a part of that as well. But you want to know where this AI revenue is coming from for these software vendors, because that's where the buck stops. If the consumers are actually buying, the enterprise customers are buying in. For Nvidia, it's great all day because these companies are going to keep building it until they get something or they don't get something. And we've seen some reports where customers weren't exactly happy with Microsoft's Copilot just yet.
All right, well, we're going to continue talking about it because it is the big story of the morning. It's really what is driving the broader market action. Josh and Dan, thanks so much for breaking down NVIDIA's results for us here and really what it means for the broader market. But let's take a look at this move that we're seeing in pre-market trading. You've got shares up just about 11%. This coming after the AI powerhouse does it yet again. Shares soaring after reporting another quarter of record sales. Also, the company issued strong guidance, this showing that momentum for the AI boom still remains well intact. So let's break it all down. We want to bring in Dan Ives, Wedbush Securities Managing Director and Senior Equity Analyst. We've also got Paul Meeks, Harvest Portfolio Management Co-CIO. It's great to have both of you. Dan, let me start with you. I have your note pulled up right in front of me. You called this a game changer moment for tech bulls and AI revolution. What does this tell us just about the momentum that's behind AI investment right now and what that's going to do not only for NVIDIA, the leader within this space, but what it means for many of its rivals out there as well?
Yeah, I mean, look, the godfather of AI, Jensen, NVIDIA spoke, and this is going to fuel the rest of this tech ecosystem from the hyperscale players, Microsoft. You look at Google, Amazon, and others, and I believe this is a start going back to the fall of a new tech bull market. It's a Taylor Swift moment for tech bulls. And this is something where it's get out the popcorn, the bears go back deep into hibernation mode.
Paul, I want to bring you in here. I mean, when we hear on the call that Jensen Huang talking about the company's ecosystem and specifically who plays into that ecosystem, it's the OEMs, it's these original equipment manufacturers and design manufacturers as well. How much does this permeate to some of those OEMs who can also kind of ride on the coattails of this demand that NVIDIA is seeing for its generative AI products?
I actually only want to appear so I can see what Dan Ives, my buddy, is wearing today. That's always my trigger.
He's in Hoodie Dan mode. I don't know who's better, Hoodie Dan or Hoodie Mellow.
I love it.
He's got it. Go ahead, Paul.
How you doing, Dan? All right, so here's what I think. I don't necessarily see that much of a play in some of the hardware OEMs. I think we continue for some time, at least the rest of this calendar year, maybe through next year, with the build out of large language models and then the inference from those models. And so I see opportunities maybe in hardware, something like a Supermicro that was hammered hard on the anxiety heading into NVIDIA's print. Of course, now they'll continue to rise with NVIDIA. But infrastructure build, first and foremost, for another couple of years before we really see plays in, like, for example, the AI-driven PCs. We'll see how that plays out for folks like Hewlett-Packard and Dell. But I am still squarely with AI and the continued build out of large language models and then inference before we step into that next realm. Because again, I don't think it's going to happen for a year or so.
Dan, the largest customers of NVIDIA is big tech. You've got Amazon, Meta, Microsoft, Alphabet making up about 40% of NVIDIA's revenue. I bring this up because it begs the question, what happens when we start to see a reduction in CapEx from some of these larger players? Is that a risk to NVIDIA, or how should investors be thinking about that?
Look, I think Paul nailed it. And he's been early on AI as well. I actually think 3 months from now when NVIDIA reports, he could be wearing my hoodie, maybe for the next quarter. But look, it comes down to, you look at CapEx, the big tech's getting stronger. I mean, when you look at Microsoft, they're still in acceleration mode. So that's just not a worry for at least the next 12, 15, 18 months. And remember, you haven't even had the consumer piece start to come in. That's why I believe it's a 1995 moment. Paul hit on it, the infrastructure. Right now, I think the big focus, second, third, fourth derivatives. The Godfather spoke. Who else benefits? That's why I believe this AI party is just getting started.
Dan, just to follow up on that, what does the consumer pick up? What does that early adoption need to look like in some of the core hardware and devices that this is going to play a huge role within, and perhaps be lighter fluid for the way that we even engage with technology that's at our fingertips or in the workplace?
Well, Brad, right now it's all about enterprise. I mean, that's the golden goose for the next, call it 12, 18 months from an actual growth perspective. The consumer, that's what Meta's looking at. We believe Apple, that's what they ultimately unveiled, WWDC. You look at how Google's going to play this. That's going to be a 2025, 2026, which speaks what Paul said. I mean, this is just the beginning of this AI revolution.
So, Paul, it's just the beginning of this AI revolution, but talk to us just about how extensive NVIDIA, specifically their moat is. And if it goes beyond that right now, if we're talking 5, 10 years down the line, who else do you see as amongst the leaders within the space?
So you're asking me, sorry?
Yeah, Paul.
Okay. Yeah, so I do think that AMD, which is a company that had been given up for dead years ago, but it's very well managed now under Dr. Lisa Su, they will take some share. Now, they will take some share, though NVIDIA, whether it's the continued build out of large language models or even in inference, will continue to have not the total share, which is essentially what they have now, but they'll still have a dominant share. But AMD should play a role. And also, I probably would, give, and I have this in my portfolio, some kudos to Taiwan Semiconductor. Taiwan Semiconductor will continue to enable all these folks. So I like not just NVIDIA, I like Supermicro, I like Taiwan Semiconductor, I like some of the other semiconductor capital equipment companies like ASM. And then, of course, I do think AMD, Advanced Micro Devices, will gain some traction.
Dan and Paul, great to have both of you here on the day. We know that there are a ton of calls that are coming out this morning after this NVIDIA earnings beat here, with Jeffrey saying it's the de facto ecosystem standard for AI. We're going to continue this conversation. Hoodie Dan and soon to be Hoodie Paul as well, joining us here this morning.
Soon to go, baby.
Yep.
Thanks, guys. Appreciate it. We also want to turn now to the broader markets. NVIDIA driving the rally in stock futures this morning as investors clearly optimistic on the AI trade right now. And that's enough to offset concerns about a delayed rate cut. Treasury yields mixed this morning, the 5 to 10 year moving higher after minutes from the Fed. The latest Fed meeting showed that the central bank is more worried about the risk of moving too quickly. 26% of traders pricing in that first cut in May. That's down from 35% last week. This is according to the CME FedWatch tool, and 53% a month ago. Some of the notes from the minutes here, and specifically what they had mentioned within that meeting, that most of the participants actually noted the risks of moving too quickly to ease the stance of policy and emphasize the importance of carefully assessing incoming data in judging whether inflation is moving down sustainably to 2%. That is your cold water for these markets right now, especially that have looked out to May at this point to try and figure out when that first rate cut is coming.
Yeah, Brad, you're exactly right. That is the cold water. And also keep in mind, my biggest takeaway was that was also said before the latest two prints that we got on inflation just last week. So that's pouring even more cold water on the argument potentially here that the Fed should move very quickly, or the Fed should move soon, maybe is a better way to put that there, rather than delaying. So the fact that they were a little bit too worried before the last two prints, we know we don't want to put too much emphasis on just a couple of prints, but I do think it's important to point out that there was some worry that was clearly shown here by most of the officials, according to this minutes about, or several, I should say, noting that the risk here would be moving too soon rather than the rest. I think that really points to the fact that we are likely going to be in this higher for longer environment than what the street was pricing in. We saw a lot of optimism going back to the end of last year, early this year, that we would get that early rate hike, and it seems like that is now continuously being pushed out, given the fact that maybe this last mile in the fight to tame inflation is going to be a bit tricky. Maybe some of these data points that we've gotten over the last several weeks here isn't exactly conclusive of the fact that the work has been done. Right. Maybe the rates do need to remain a little bit higher, more restrictive policy here in order to get the job done. But it also just highlights the fact that this is very much still a debate that's live and well. When you take a look at an economist reaction to this, even strategist reaction, trader reaction, we had the board up there earlier talking about the timing of that first rate hike. There's still those in the camp that they believe that the Fed should and will act early. So it's too early to say, but I think the case is being made and the case is growing stronger for that later first rate hike, and that's clear.
Yeah, exactly. And when you mention some of the reactions that we're getting from economists and some of the largest portfolio managers with the largest asset under management, BlackRock specifically comes to mind. And David Rogal, who's over at BlackRock, actually put out some notes after these meeting minutes dropped yesterday, saying the more interesting question in their view is not when the Fed starts cutting rates, but rather how far they want to cut here. And particularly looking out, they've seen an increasing number of Fed speakers referencing a potentially higher neutral rate this cycle. And so all of that considered, it really kind of comes with this broader context of where we have to look back to. During the great financial crisis, the Fed's estimate of the neutral rate, that came down to 4%, from 4% to around 2.5%, still stands in the SEP. And that decline, they also mentioned in context here, came alongside a long period of low and stable inflation. And so it's a larger question of just how far they are actually willing to cut, and once those rate cuts begin, what the pacing of that is too.
Yeah, exactly. And that's been, we've heard from a number of economists right here in the program that's a critical question. Yeah. Not so much the timing of that first rate cut, but exactly what the pacing, what the pacing will look like then of future cuts after that first. All right, well, let's take a look at one of the big movers of the morning, and that is Moderna shares climbing to the upside, up just about 6% after posting a surprise profit in the fourth quarter, despite seeing a 43% slump in COVID-19 vaccine sales. Yahoo Finance's Anjali Kamlani spoke with Moderna's CEO about those results minutes ago. Anjali, what did you hear?
That's right, Shauna. Moderna surprisingly coming out with the beat this time, despite the fact that we've seen the waning COVID vaccine story play out for it and other companies. But the company is saying that they do see the market for this. They, in fact, did increase their market share for COVID vaccines in the last quarter. So really a strong story there. And it has been a year of transition. And that's really the sort of takeaway that CEO Stéphane Bancel told me earlier today. Listen to what he had to say.
Last year was a transition year, as we said all along last year. We right-sized manufacturing, took a big write-off, mostly non-cash, in the fall. And now I think we're really off to the races. We have been gaining share in the US, and our objective this year in 2024 is to increase vaccination rate.
So as you can see, that write-off, of course, with $2.2 billion, right-sizing manufacturing, and then focusing on the RSV vaccine launch, what they expect to happen this year, could add to the revenues for the company. In addition, they're working on their combo flu and COVID vaccine, and they also have that partnership, of course, with Merck for the cancer vaccine, and all told, looking for a strong future. But it is interesting also to see where Moderna is playing in the market with a focus on vaccines and infectious diseases, also at a time where oncology is big, as well as AI, Moderna being one of the first companies to really use AWS to be able to identify the current COVID-19 vaccine. I asked Stefan whether or not that is sort of an example of how far along the technology is, or whether or not AI still has a little bit of a drawback. And here's what he had to say.
If you look at large set of data, to look at patterns on very large set of data, this is where machine learning today is actually very adapted. And that's the type of use we are doing. We're not using to report financials. This is still done by standard systems like SAP and standard technology. But when you're dealing with very large set of data, the ability of machine learning system to look at patterns and to see things that a human cannot see because there's just so much data, that part of the technology we believe is ready.
So as you can hear, definitely some future in there, and whether or not the company continues to grow beyond that, what it has in its pipeline is what investors are waiting to see, but still a strong result and still bullish on the potential COVID market is where Moderna currently stands.
All right, Anj, thanks so much. We will be talking with an analyst from Oppenheimer with an outperform rating on the stock here later this hour. Get his thoughts on this report. All right, Anj, thanks so much. Well, coming up, Wayfair getting a boost in pre-market trading after reporting a narrower than expected loss. We're looking at gains of just about 6% in the pre-market. More on that when we come back. Time for today's stock to watch. Wayfair shares gaining in pre-market trading after posting a narrower than expected loss and seeing an uptick in active customers from a year ago. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange with the details on one of those movers. Maddie.
Yeah, Shauna, Wayfair's stock surging after those results. And there are a lot of important details here that I want to dive into because I think it paints a broader picture about some of the themes we're seeing in this market. One of them being these repeat customers. That was one of the things that the CEO cited on the call as being a huge contributor to Wayfair's beat here. They talked about those repeat customers being up. That's an indication to me that this is one of those names that could benefit from the higher for longer rate cycle. And that's because people are stuck in their houses with lower mortgage rates. They can't get out because rates are too high right now. And so they're looking around and saying, hey, let's upgrade the furniture in this place if we're gonna have to be here for another couple of years. Wayfair benefiting a lot from that. Another big theme we're seeing here, job cuts leading to more efficiency. The CEO cited that on the call as well, talking about the capital allocation to those job cuts being worth it in the end because it led to more efficiencies. So my question is going to be whether or not they're going to be able to continue to show that profit growth, beating out their expenditures moving forward, and if the higher for longer environment is going to continue to be a boon for Wayfair.
All right, something we will continue to watch. All right, Madison, we'll check in with you in a few minutes here at the opening bell. Well, Etsy shares another reading on the consumer trading in the red. Now, this move to the downside coming despite the fact that it beat the street's estimates on some key metrics. E-commerce company here posting lackluster guidance, though, as it points to a slow start to its fiscal year. And that's why we're seeing shares in the red. So joining us now, talking about what's ahead for this company, I want to bring in JMP equity research analyst Nick Jones. Nick, it's good to see you here. So they did beat when it comes to their most recent quarterly results, but that guidance and the warning here of a softer 2024 pressuring shares. Do you think the move lower in the stock, is that warranted?
Yeah, I think it is. Etsy is one of those platforms that's always commanded, or the stock's always commanded a higher multiple. So if you want to command a higher multiple, you got to give, kind of better than expected results. So I think when you come in with a little softer than expected guidance, that resets expectations. The stock usually moves accordingly. That all said, we really like the stock here. We think the price is an interesting entry point. And there's a lot of green shoots in the business despite the slow start.
In one of your most recent notes as well, I mean, you talk about the language learning models, the generative AI, the investment in product development. What do you expect to see on the investment front, and how will you be tracking to see where that actually shows up in some of the financial performance at the end of the day too, where customers are feeling like they have a more enriched experience that leads them to drive up that gross merchandise sales and volume on the platform?
It's a great question. I mean, one of Etsy's biggest opportunities is unlocking frequency, right? It's getting buyers to spend and then come back and do it more frequently. Etsy has no SKUs. There's no barcodes. It's not easily indexable listings on their site. So by deploying large language models and generative AI, they can start deploying tools that help users get to what they want faster. And an indication of this is their recent launch of a product called a technology called gift mode, where you can kind of go through a generative AI powered funnel to get a gift for a loved one. If you're trying to whittle it down and you don't want to spend the time kind of searching through all the listings, they can kind of curate it for you using that technology. So I think that's just kind of early signs of what's to come, of where they're going to be investing behind.
What does that then mean, Nick, here for revenue in terms of the bottom line impact that you're seeing down if you take a look at 3 to 5 years from now, once we get a little bit more traction on that new product?
It's really tough to say. It's early. They just launched this before their first ever Super Bowl campaign a couple of weeks ago. So it's really early to determine what that's going to look like. I think really the driving factor behind growth is they had a massive pull forward of demand during the pandemic. They've still maintained most of the buyers from that. They're lapping kind of tough comps. When we start looking 3 to 5 years out, I think the key driver is going to be the macro environment. We looked at the back half of this year in decreasing interest rates as an indication of probably a more aggressive consumer in terms of discretionary spend as they start to feel more comfortable about their financial situation. So I think the macro is really the driving factor of what things are going to look like. And all these investments today should just help them accelerate growth out the other side of the current kind of pressured consumer.
Nick, very quickly here, you got Temu that ran like 15,000 commercials during the Super Bowl. You've got on the other side Shein that's looking to make a public debut. You've got fast fashion that absolutely just kind of drives so much of the clicks, the search on social media platforms as well. How does Etsy really maintain and retain consumer mind share in that environment? We only got about 20 seconds.
Yeah, that's a great question. Really, Temu and Shein are flooding the ad markets with what appears to be irrational spend. So the real question mark, I think, for most investors are, how long will they keep this up? And do they pull back eventually, kind of bringing down cost per clicks for the rest of the e-commerce players? We don't really view them as a kind of an existential threat to Etsy, more as distorting the advertising market, making the LTV, the customer acquisition cost, a little more challenging for companies like Etsy. So near term, problematic for advertising. Long term, we don't really see them as direct competitors to Etsy.
All right, Nick Jones, always great to have you inside here on Etsy. As we ring in the opening bell on Wall Street, Nick Jones, Citizens JMP Equity Research Analyst, thanks so much. Well, we've got the opening bell on Wall Street, and it looks to be a huge day here for the market. Many investors, traders excited about the earnings results that we got here from Nvidia after the close yesterday. That is really driving today's market action. We've got team coverage for you here at the opening bell. Madison Mills still standing by on the floor of the New York Stock Exchange. We got Jared Blickery at the big board for us. Maddie, what's the word on the street? I'm guessing lots of chatter about those Nvidia results last night.
My sources here on the floor saying the CEO of Nvidia is the Taylor Swift of this stock market today. And I'm just taking a look at the boards. I mean, we love the Taylor Swift mention. Seeing a lot of green on your screen. The S&P up 1.3%. Even the Russell, which has been struggling, up 0.4%. The question for me, though, and this is what Jay Woods just told me this morning, how does Nvidia perform in the first 30 minutes of today's trade? That is what's going to indicate whether or not they're going to be able to break out of this kind of tight upper range that they've been in. Having said that, they're obviously doing very well, adding the entire market cap of a Cisco, of a McDonald's into their overall market cap after that earnings report yesterday. And we're seeing that read through to other chips names as well. Intel, AMD, all up significantly in today's trade. I quickly want to mention, though, you guys, to be extra smart, look at what's going on in Japan with the Nikkei index hitting a 34-year high after we've been saying that we're in a recession in Japan for some time now. Why is that? That's because of some of the suppliers to Intel soaring in the Nikkei index overnight. So interesting to see that Nvidia is not only defining the U.S. trade, it's leading to a global stock market rally. My big question, what's going to be happening with Nvidia as we continue throughout the trading day today? Is it going to continue to lead us to higher highs? We'll find out as the day goes on.
Yeah, good shout out there. As the Nikkei you're seeing there on the screen, up by about 2.2% is where it ended the day's trading activity. Thanks so much, Maddie. We've got even more of that global view from Jared Blickery here at the home base with the Wi-Fi Interactive. Hey, Jared.
That's right. We're seeing a rebound from some of the recent weakness. Nasdaq up over 2%, S&P 500 close on its trail, in the Dow, bit of a laggard, up about 0.6%. Small caps up a little bit less than that. Now, tech, not surprisingly, is the biggest outperformer. In fact, the only outperformer next to the S&P 500. It's up 2.5%. We do have consumer discretionary up about 0.9%, and industrials and communication services and financials also in the mix. I haven't talked about financials recently, and I promise we'll get back to Nvidia, but I just wanted to show that they have really taken off recently, and this looks like a giant sideways pattern, which it is, but importantly, we are breaking to the upside right now. And if we take a look at some of the stocks inside, I was particularly interested in Goldman Sachs. That's up 0.5% today. This is in a tight consolidation. This is a 2-year chart, so kind of hard to see, but there's a 3-month chart, and you can see a lot of tight sideways action. So maybe some catalysts will be able to propel it to the upside or downside out of that range. And then taking a look at our leaders index, not surprisingly, semiconductors, that is up 4%. That is a huge amount for that index. Momentum trade is doing well. Software, not to be left there in the tech field by the chip stocks, that's doing well. Also, Chinese stocks, looks like they're up about 1.5%. So we'll check on them real quick here. We can see a lot of green. Pinduoduo up almost 2%. JD.com up over 1%. And now let's get to the Nasdaq 100. Want to check out Nvidia here, up 12%. And guess what, guys? Up 54% over the last 3 months. And with this latest gain at $753 per share, it is going to make this list, if we were to close right here, somewhere around number 4 or 5 in the top one-day market cap gains, tracking over $185 billion right now.
Certainly is amazing. All this excitement surrounding Nvidia here. You got Nvidia stock at a record high at the open. Jared, thanks so much. We've got much more of your market action ahead. Stay tuned. You're watching Yahoo Finance. We're looking at gains at the open, a lot of that being powered by what you're looking at on your screen. We've got Nvidia shares up just about 12.5%, hitting a record right at the open here following the stronger than expected results that really blew it out of the water in terms of what we were expecting from the street here. So what does this mean for the broader market? The rally, does that mean that this is all intact? Who better to ask? Our very own Miles. Miles.
Our very own, rather than someone else's, of course.
Very own, our head of news, all the things. But let's just talk to, because you and I have been talking about this for years now. Obviously, the excitement building up here surrounding Nvidia. They haven't disappointed in quite some time. When you take a look at these numbers, it doesn't look like this momentum is slowing down anytime soon.
I think what's interesting about the Nvidia story right now is if you look at the fundamentals and you look at like the percent change year over year that you see on the top line and the bottom line, and they get a bunch of different metrics, but just look at net income. Those gains are basically in line. They're slightly lagged, but they're basically in line with the rally that we've seen in the stock. Now, oftentimes, given that investors are forward-looking, second derivative, change in the rate of change, you will see the stock price in a, let's not use the B word, but like a name where there has been a lot of concentrated enthusiasm, you will often see the stock price start to really get ahead of what the results actually reveal. And I think what's so kind of notable today for Nvidia, this is the fourth straight quarter that we've done this like, oh my gosh, I can't believe how much they just raised their guidance. Those numbers are still in line with what we've seen in the percent increase in the stock. Now, obviously, the market cap gains are getting gaudy. We're up $200 some odd billion in market cap alone. What a fun game to go through and say how many other companies aren't even worth that. Most other companies are not worth that. But just the fundamental business story, keeping up with the stock at this point in the story, I think is really notable this morning. And Maddie told us we have 21 more minutes to see how this shakes out. But right now, the bid at 760-ish seems pretty firm in Nvidia.
I mean, we've already heard calls this morning. Jefferies, for instance, saying that this is the de facto ecosystem for standard AI. So how does that broaden out further from beyond just Nvidia to now some of the OEMs that they talk about on the call, some of the other suppliers that are core to manufacturing, what goes into the data center, what goes into the products that they eventually produce on the chip front as well?
I think what's challenging about the Nvidia story at this point in time is that it is not entirely clear who else is going to benefit at this scale, given that it seems most of their customers are the Metas and Googles and Microsofts of the world, the other massive AI plays. I mean, this is why it's the Magnificent Seven trade. So I think it's so funny, to see it's all NVIDIA, and Jared comes on, he's like, let's talk about financials. But I think that I was thinking kind of the same thing myself, where the zag here is like, all right, AI trade is established. It's NVIDIA. You're not going to get in trouble as a portfolio manager having some position in NVIDIA right now. Maybe if you chase it, you'll get in trouble, but it's probably fine to write a letter to your investors. The question now is is this rally is a rally even more stealthily durable underneath the surface because all the intention's on Nvidia? Maybe you are looking at some of these 2-year-long do-nothings breakouts from a Goldman Sachs, from financials more broadly, not because they're going to benefit from AI, but because sentiment in the market now is so bolstered by AI. Everyone's looking at what's the next opportunity, and things that have gone nowhere for 2 years, and there's quite a few of them out there, those might be the places that people start putting money in.
Miles, you brought up chasing it, right? And we've been talking about the FOMO rally, how much of this is driven by people just trying to jump in. They've seen the gains that have happened over the last 15, 18 months, and they're saying, hey, why didn't I buy this sooner? Obviously, but now there's still no reason, I guess, or the reason to stay on the sidelines is getting weaker and weaker. The risk, though, that poses to the broader market, when we're talking about the FOMO rally, the buildup that we've seen, all driven by really the results, many of the results, or much of the focus here by one name.
Yeah, so I think that gets to the portfolio construction question, which is why then you start looking at things like industrials, healthcare, financials, utilities, even, right? Obviously the rates trade last year, that was a challenge. I think all of these areas are places that you as a portfolio manager are going to say, I might have been late on Nvidia. I don't know how much I want to chase it here. Maybe I'm going to get in trouble for, the famous Stan Druckenmiller story, right? He knew he shouldn't go overweight tech, and then in 2000 he goes overweight tech and the market crashes. So are investors now looking around and saying, I need to come up with my next best idea, even if I'm not totally sure? This is kind of why the Fed rates trade has taken a back seat, because that trade, like that fundamental basis of the market has gotten significantly more challenged over the last 6 weeks. And yet the reason that it's okay is because Nvidia has a lot of chip orders. It's a very strange kind of logic, but I do think when you have so much money out there that has to go somewhere, you don't pay 2% to have sit in cash. You start to look at these other areas, which creates this kind of, like, to your point, Shauna, you're chasing a non-AI trade because of AI, if that sort of logic makes it. This is like the thread that I think to me is where we're at right now.
Yeah. Makes a lot of sense.
All right, we could talk about this all day. There's much more actually that we're going to.
I'm happy to charge 2% for these ideas if anyone wants to take them.
You can.
Tell you, you're welcome any day.
Well, the morning brief is free to read, for people out there. So
make sure you
emphasize that.
Miles Edlin, thanks so much for taking the time. Guys, coming up, Moderna's surprising profit. We'll break down those results with an analyst from Oppenheimer. That's coming up next.
Now, shares of Moderna up just about 6.5% this morning after reporting better than expected sales when it comes to the estimates that we got here from the street. Now, all this coming despite the fact that sales for its COVID-19 vaccine have pulled back just about 43% from a year ago. Yahoo Finance spoke with Moderna CEO Stéphane Bancel about the decline in COVID vaccines, and here's what he had to say.
I think we can do much better as a company and also working with public health leaders to increase vaccination rate. You know, Americans need to know if you are 65 and above, you have 5 times more chance to get hospitalized because of COVID than because of flu. And as you know, many more people take a flu shot than a COVID shot. So we have to do better there.
All All right, for more on these results, we want to bring in Hartaj Singh. He's Oppenheimer's biotechnology analyst. Hartaj, it's great to see you here. So I would love to get your reaction to what we just heard from Stefan Bancel, and also just putting this in perspective for us, because over the last couple of quarters, we've talked about the risk of the decline in the uptake here of COVID-19 vaccines, what that risk or challenge then poses here to Moderna. Are we starting to see that narrative shift just a bit as we get more positive results on RSV and also some of the excitement surrounding its cancer immunotherapy?
No, thank you, Shauna, and I really appreciate you all having me as always. Look, here's the thing. This has been a story around COVID-19 vaccines, the sales, and the underlying trends. When we upgraded earlier this year, we basically said that, look, this is a story that this year will change from COVID-19 vaccine trends and COVID-19 vaccine revenues to basically, a pipeline story, and with the company being potentially a 5-product company in 2026. And I think today what you saw was, they reported COVID-19 vaccine, revenues that were in line with what we were expecting. This probably should be the trough year. On the call, the company, reiterated their guidance for the full year of 2024. And especially, I think in January and February, it didn't seem like there was any big change to vaccination trends one way or another that should give us pause, that this should be a trough year for COVID-19 vaccine, COVID vaccine revenues. The second part, to your point, that more and more the conversation is coming up on their pipeline. On conference calls, investor calls, 70, 80, 90% of the questions used to be on COVID-19 vaccine revenues. Now people are talking about flu. Phase 3 will read out this year. The combination flu and COVID-19, a phase 3 will read out later this year. CMV, cytomegalovirus, this is for pregnant women. That will hopefully read out later this year. And cancer vaccines, rare diseases, those are trials are initiating. So you can already see subtly the change, happening where we're going from discussing COVID-19 revenues and vaccination trends relentlessly, like Stefan was talking about, to now really talking about the pipeline.
Well, the shares right now down by about 41%. Investors waiting for that pipeline story to really ring through to some of the financial results. So where are we in the mRNA platform, messenger RNA as a platform, and iterating on top of what they already have to really bring some of these new solutions, treatments to market?
Yep. Right. So, the mRNA platform is a really good question. And it matters in a way, right? So as a biotech analyst, what does a platform mean to me? A platform means that the company has an approach with either a type of a molecule, for Regeneron with antibodies, Gilead, infectious diseases, Vertex, they're agnostic, but they go after, understanding disease pathology. With Moderna, it's the mRNA. And what does that mean? What that means is you should be able to shorten development times, increase the probability of success for your development candidates that follow the first approval, which in this case it was the COVID-19 vaccine vaccines. If you go back to their R&D, slides from last year, you'll see that that's exactly what they're doing. As they're developing products in RSV, in flu, in combo vaccines, in cancer vaccines, in rare diseases, they're shortening the development times and they're increasing their probability of success. So we're already seeing that this is a company that's beating historical estimates. And that's the kind of stock you want to own, if you're a kind of a mid to long-term holder, because that means that every product will just get on market faster with a higher degree of certainty.
Right, cutting down some of the R&D costs as well along the way here. So for investors that are looking around that time horizon, how far out should they be looking?
Look, the first 6 to 9 months here is really just going to be all about the pipeline. We're not going to see COVID-19 sales until, the insights there until about, the second quarter call in late July or even the third quarter call in late October. So really the discussions in the next 6 to 9 months are going to be all centered around the pipeline, which I think is great because people are now going to start getting comfortable with the idea that they should have a flu vaccines approved next year, RSV approved this year, a combination vaccine, flu and COVID-19 approved next year, cytomegalovirus vaccine possibly approved next year. The readout is good later this year. So what we're going to see now is a relentless discussion the next 6 to 9 months around the pipeline and these projects. So we should start seeing it very quickly. And, our upgrade stated in January, a couple of months ago that this should be a 5-product company in 2026. And the update today, underlined our conviction there.
Oppenheimer analyst Hartaj Singh. Hartaj, thanks so much for taking the time here today to break down the Moderna results. Certainly appreciate it.
Thank you for having me.
Guys, coming up, shares of EV makers Rivian and Lucid trading to the downside this morning on disappointing guidance. We'll dig into what the results mean for the EV demand after the break. Welcome back. Let's take a look at some trending tickers that we're tracking here on Yahoo Finance. You're taking a look at some EV stocks. Shares of Rivian will begin there and Lucid hitting a speed bump after 2024 guidance falls short of Wall Street estimates. Meanwhile, Nikola edging higher after reporting a narrower loss in the fourth quarter as the company posts higher deliveries here. Let's zero in first and foremost on Rivian. This was one of the top trending tickers that we saw here when we were even going into our morning meeting this morning. They did see 167% increase in revenue in 2023. However, the delivery of these vehicles are certainly going to be in focus here. And at the price points, too, the top selling electric vehicle over $70,000 in the United States for 2023. And so really how they're looking across bringing some of these price points down in an era where Tesla has really initiated an all-out price war, and it's kind of impacted the margins at some of the other players here within the EV landscape as well.
Yeah, it certainly has. And this all points back to the fact that we are seeing a bit of a diminishing demand when it comes to EVs, obviously not living up to those initial expectations. As a result, the production forecast and what many of these smaller players, smaller competitors within the marketplace are forecasting here coming in well below of what the street was looking for. Obviously, they don't have a heck of a ton of cash when they're not bringing in as many deliveries that they had initially anticipated or what was initially forecasted here going into some of the hype surrounding EVs. So we're seeing a bit of an adjustment here as a result. When it comes to Lucid, you had bared out with their reaction, saying that they're noting the fact that the company continues to grapple with what is a very challenging environment for EVs. And then you pair that with the high price points that come with Lucid, and it is a challenging setup here and one that is likely going to remain a headwind for this industry now for potentially a couple of quarters.
Yeah, and just lastly, we'll round this out with the company that's coming in last, at least as of right now, year to date, down 15%. It's been a troubled story for Nikola, and ultimately here on the day, even though you're seeing a little bit of barely a reprieve, just flat, barely to the upside right now, the stock trading around 70 cents a share, and for the first production here, they delivered finally, the first production hydrogen fuel cell electric truck available in North America. It's just a larger question of the scale and for some of the purchase orders that they had seen come through early on, just what they would be able to do to even make this go from concept to an actual real thing, which is the issue that landed Trevor Milton in some hot water for this company very early on.
Yeah, certainly we've seen a number of leadership changes there at Nikola. Now the CEO Gursky is taking over as the interim CFO. So clearly Nikola is kind of off by itself in terms of the troubles, the challenges, the headwinds that's facing Nikola specifically. When you take a look at the stock price, the fact that it's under $1 per share year to date, we're already looking at losses of 20%. Clearly a very challenging setup here for Nikola going forward. All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Buenos dias, bonjour. Welcome back to Yahoo Finance here on this Friday's Eve. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks jumping on Thursday following AI darling Nvidia's big earnings win, igniting a global tech rally in stocks here. You're taking a look at the Nasdaq. The tech heavy average is up 2.3% right now.
All right, let's take a look at some of those individual movers that are trending on Yahoo Finance. First up, shares of AT&T ticking slightly lower. You're looking at losses of about 2% actually here after customers of major cell service providers reported outages. This is according to the tracking website downdetector.com. Now, T-Mobile and Verizon customers have also reported issues across the U.S., but AT&T users have by far the most. That's why we're seeing the most reaction in that share price. Again, a name to keep on your radar today.
We're also tracking shares of Royal Caribbean climbing higher on cruise demand continuing to boom here. The cruise liner raising its full year guidance, saying bookings are up significantly higher than they were a year ago. Royal Caribbean now expecting 2024 adjusted earnings per share to be between $9.90 and $10.10. That's compared to a prior range of $9.50 to $9.70 per share that the company forecast on February 1st.
All right, and we're also watching Planet Fitness this morning. The fitness center topping the street's revenue and same-store sales forecast, but provided a weaker annual growth outlook. Now, in the company's latest results, Planet Fitness called 2024 a year of transition after announcing Chief Financial Officer Tom Fitzgerald is going to retire in August after holding the position for 4 years. Now, the camera wasn't on you, but you really gave a fist pump there for that beat.
That's my gym. Got my Black Card membership. Take it everywhere I travel.
You're very loyal.
Yeah,
Gym goer there.
Some significant.
Twice a year?
When I travel.
Yeah, I know.
Like I said.
All right, guys, let's get to some breaking news here that we have at the top of the hour. Existing home sales rising 3.1% in January from the month prior, but that's almost down from a 2% slip compared to last year. Total inventory is up when you look at those year-over-year basis. So let's put it plainly here, because existing home sales expanding 3.1% in January, and that's to a seasonally adjusted rate of just about 4 million. Sales, though, did decline 1.7% from a year ago. And Brad, when you take a look at some of these other numbers that we're getting, the median existing home sales price, that's up 5% from January of a year ago to $379,100. Not exactly a huge surprise. We've been talking, you and I, about the fact that inventory remains extremely limited. People are locked into those lower rates. They're not putting their homes on the market. As a result, those buyers that are still looking to purchase either their first home or a new home there are bidding up some of the prices here. And many of these homes are selling for much more than they would have a year or two ago.
Yeah, it's me. Hi, I'm the problem. It's me. I'm trying to get in the market. Can't do it right now. According to Freddie Mac, also within this result, the 30-year fixed rate mortgage averaged 6.77% as of February 15th. That's up from about 6.64% the previous week, 6.32% 1 year ago. Just lastly, and I'll end on this, we got a comment here from the National Association of Realtors chief economist Lawrence Yoon, good friend of the show here, and he ultimately said that while home sales remain sizably lower than a couple of years ago, January's monthly gain is the start of more supply and demand. Listings modestly higher, home buyers taking advantage of lower mortgage rates compared, again, though, to last year here. So we'll continue to watch and monitor where those rates are starting to tick back up on the mortgage side, according to some data from Freddie Mac. Also here, staying on the home front, existing home sales, they declined 1.7% from last year, but inventory unsold existing homes rose 2% from a year ago as supply challenges and higher mortgage rates continue to impact home buyers. Let's bring in Brad Case, who's the Middleburg Community's chief economist, to weigh in on these numbers. Brad, I just want to get your take and your read here on this existing home sales print rising 3.1% during the month of January.
Well, this is good news. You know, I've been a little bit concerned about the single family home market because we've seen prices for existing homes decline over the last several months. As you noted, they're above where they were a year ago. But the last few months have been weak. The number of sales, of course, has been very weak, and we need to see a healthier housing market to support the entire economy. And so this print does give us some hope that the owner-occupied housing market is not going to drag down the rest of the economy. I had been looking at this and thinking, wow, we haven't seen anything like this since the mortgage market meltdown of 2005, 6, 7, 8. But this month's data looks a little bit less like that problem.
Hey, Brad, when it comes to exactly what it's going to take here to turn it around, I think a lot of people are out there asking about the timeline of this when it comes to that recovery, what that trajectory looks like. What are you anticipating once the Fed does potentially cut rates? What does that recovery timeline look like?
Well, I don't think that we should plan for the Fed to cut rates anytime soon. And that will, of course, mean that mortgage rates won't come down very, very much anytime soon either. So potential home buyers should not be looking for big declines in mortgage rates. You should buy a house only because you found a house that you want to live in. You can't live in that house unless you buy it. we've seen demand increase generally for housing, both owner-occupied and renter-occupied. Now, in the rental market, we're able to see the increase in renting activity. In the home buyer market, the problem is that the existing homes haven't been put on the market because the existing owners don't want to put themselves into a higher rate mortgage. So that's still a problem. What we'll really have to see is that the existing home owners have to understand that they simply don't have an asset that is worth as much as they were hoping it would. And that will help them to put more inventory on the market, and that will help the entire market.
How might that lead to regional shifts as well from what you're tracking, Brad?
Well, a lot of the demand that we've seen is demand from people moving from one part of the country to another. And so certainly, my company is most active in the southeastern part of the U.S., and we're still seeing increase in migration toward the southeast, and that's increasing demand for housing on the owner side and on the renter side. But the biggest increase in demand, I think, is coming from the tendency of people to move out of their parents' basement, move out of the house they've been sharing with their fraternity brothers. And so I think that's going to continue, and that doesn't depend on mortgage rates. What mortgage rates and house prices determine is whether those people who are moving out from the basement are going to move into a rental unit or try to buy a house. And it's just really hard to buy.
Yeah, Brad, it's extremely hard to buy right now, given the fact that home prices have risen so much, given the fact that mortgage rates are where they are today. I'm curious, since you're in the commercial real estate space, you focus on multifamily there. What are you seeing in terms of that trend line? Because we're starting to talk about multifamily more and more just in terms of some of the weakness that we have seen, not so much in your region of the country, but when you look at the country as a whole.
Well, in the rental market, what we see is more demand growth than we were predicting. And that's, as I said, those people moving out from their parents' basement. And so that's great news. Now, a year or two ago, what was resulting from that was a big increase in rents. But more recently, over the last several months, over the last really year, rents have come down, and the rent growth has been very close to zero. So we are expecting to see, now we were predicting that rent growth would be actually less than zero. So what we're seeing is that people are finding it easier to rent. They're not getting bargains in the rental space, but they're not looking for bargains because they can't get those in the owner-occupied space either. But what they are seeing is that they're able to move into a rental place without paying the astronomical prices that they would have to pay if they were trying to buy.
Is wage growth keeping pace with what you're seeing in the rental space? And then on the other side, I guess, as well, added for anyone who is trying to purchase a home or trying to get into a mortgage stretched out over 15 or 30 years, whatever that looks like. How are wages keeping pace with that?
Yeah, wage growth and income growth have been very, very strong. And so when I look at house prices, if we hadn't seen such a big increase in wages and income, I would be very concerned about a bubble in house prices. I'm not, because of the fact that income growth is supporting it and wage growth is supporting it. And so what we're seeing is that people they're not used to paying so much in rent. They're not used to paying so much for a house, and they're certainly not used to paying so much for a mortgage to buy a house, but they're able to afford it. And that's what's making it possible for them to form a new household and start looking for housing, whether it's owner-occupied or rental.
Brad Case, great to have you. Hope to have you back here on Yahoo Finance soon. Middleburg Community's chief economist. Thanks so much.
Thank you.
Well, coming up after Nvidia's strong earnings report, is the hype around AI actually a risk to the markets? We will talk all about that with a strategist when we come back. Nvidia shares hitting a record here this morning, surging over 15%, adding more than $200 billion to its market cap. Now, this coming after the company's earnings results blew past the street's expectations. The move here this morning and also the rally that we're seeing more broadly across the spectrum, showing that the AI-fueled rally still has more room to run, at least for now. Let's talk about what it could mean as we take a look at the longer term. For that, we want to bring in Jeff Bierman. He's TheoTrade, a chief market technician. Jeff, it's good to have you here. So there's been so much talk about the fact that a lot of the market gains that we have seen over the last 15 months or so has been driven by the hype and excitement surrounding AI. Does this pose a potential risk here to the broader market to you?
Well, first things first, Sean, I want to clarify, it's not hype. It's the real deal. AI has arrived. Okay, the earnings from Nvidia are absolutely spectacular. You can comb through it and look for any negativity, but there really isn't. And they did guide higher for the next quarter. However, the question comes down to this. It's not about hype. It's about how far forward have AI stocks priced cash flow and earnings and valuations. Is it 6 months? Is it 1 year? Is it 2 years? I don't have a handle on it yet. I'll let the market sort it out. But I can tell you this, we are at overbought levels that I've never seen. And overbought is a condition. It is not a trigger, which means you automatically turn and sell. Overbought can persist, but it is a warning that the market is getting a little bit beyond FOMO here. And there's a concentration risk factor, meaning that most managers are just throwing away every stock they can to get into this AI revolution, and they're missing bargains all over the place in other sectors. So the concentration risk, to me, is the biggest risk, but AI is real.
So the concentration risk is a huge risk. We've been talking about that now for some time. So when, I guess, break that down a little bit more for us, because those who have been calling it for it now for the last several months that they've bought in, they're actually doing pretty well. So why is it now, when you take a look at these valuations here outside of Nvidia, are you raising or really bringing more attention to the fact that this could pose a larger risk to the broader market?
Well, it calls into question traditional risk management and traditional investment management diversification. Diversification in this market is dead. It does not work. You can't tell me you're going to lay risk and spread it across 11 sectors and get a meaningful, effective return. It's not working. So what managers have done is they're just gravitating towards what's working and selling weakness to buy strength. So the market itself, if you just segregate just financials and just tech, it's about 60 to 65% of the entire market. Now, financials look fully priced, and they've been disconnected completely from interest rates. Interest rates are going higher, financials are going higher. That argument is past. You can bury that. Nobody cares right now about interest rates for the time being. So whether they're cut or raising, it's not an issue, because the earnings on tech sort of supersede and put that to rest. But if the market gets fully priced in tech and fully priced in financials at the same time, and I believe we're there with financials, then it poses a risk when there's an unwind for a corrective period, because it'll be like yelling fire in a crowded theater, Shauna.
Jeff, what are the technicals that you would look to determine whether or not, and the point at which Nvidia is finally over its skis, perhaps?
Well, I like to look at things on a 1 and 2 year basis, Brad, just standard deviation channels, 2 and 3. I like to see how far they can test beyond statistical measures, whether it's standard deviation or average true range. But truly, the RSI, not on a daily, not on a weekly, but on a monthly, is starting to approach that 75 to 80 level. In fact, it hit nearly 98 on SMCI on a daily basis just a couple of days ago, which is an all-time high record for an overbought stock. So once you get into these crowded trades, Brad, you can hang out for a while. But if they decide to push the button and exit, it often creates air pockets, dislocations, and gaps. And sometimes those gaps can be bought. And if they're bought and there's no bounce, it can feed on itself. And if the algos can pick off on this, the algos that run it up vertical can also take it down into a waterfall effect. So to me, you can't time it perfectly, But if the warnings are there, and they're there, you need to scale back on your concentration of your holdings.
Jeff, is this across the board? Because you said earlier it's not about hype. Yes, that's true when it comes to Nvidia, but you look at a lot of those other stocks out there that have really been riding the coattails of Nvidia. They haven't proven the fact that it's really going to return revenue when it comes to those business models. So when you take a look, are you separating Nvidia from some of the performance that we've seen elsewhere within the sector?
Yeah, I have separated them in two, Shauna. I call them the high octanes and the low octanes. So for instance, the lower octanes would be Microsoft. Lower octane would be Alphabet. High octane would be something like a Palo Alto Networks or a CrowdStrike or an Nvidia or an SMCI. So yes, I separate them. And what you're finding is, believe it or not, the Microsofts and the Alphabets are actually not as overbought as you would think they are, nor are they as overpriced as you would think they are. It's really in the high octane, sort of high profile stocks that are at the forefront, the vanguard of the AI revolution, that's driving the market a little bit crazier than it should be. But I want to make myself clear. AI is here to stay. We're in the beginning stages of this. But let's not get over our skis, because let's look back 25 years ago towards the internet age when everybody was buying everything going up and there were only few survivors. I think there are going to be more survivors here, but I think there are going to be disappointments along the way for sure.
Thank goodness I snowboard, Jeff. Thanks so much for taking the time here with us today. Jeff Bierman, who is the TheoTrade Chief Market Technician. Appreciate it.
Thanks, Brad. Thanks, Shauna. See you later.
See ya. Coming up, we're going to dig into the M&A space amid a recent rebound in deals across the energy and media spaces. That's after the break. We're seeing some landmark merger activity from Capital One acquiring Discover Financial for $35 billion to Walmart purchasing Vizio in a play to bolster its consumer ecosystem. Data from Dealogic says M&A volume is up 130% year over year so far this quarter. And we're only halfway through the first quarter, basically. So what's the outlook for the deal-making environment? Let's bring in Suzanne Kumar, who is the Bain Company Global M&A Practice Vice President, to discuss more. Thanks so much for joining us here on set.
Thanks for having me.
Absolutely. So let's dive right in here. The outlook for 2024, now that we've got some landmark deals that have already come forward this early in the year, what's the setup?
I think it's really promising. So as the Dealogic data said, M&A activity is up January and February. And there's two places where that's probably a continuation of what we saw last quarter in 2023, and a few places that's some new energy. So tech is new. Seeing some big tech deals is really encouraging. That's a place that has been down dramatically for the past couple of years. The other place that is encouraging is seeing a little bit more financial sponsor activity, so private equity investments, which has had been taking a hit over the past year as well.
Suzanne, what are you seeing just in terms of valuation? Because we were talking about the fact earlier this week, obviously, with Capital One Discover really leveling up the valuation playing field that we have seen when you compare it to some of the deals last year. What does that tell us just in terms of where we are in that cycle and some of the recovery maybe that we could expect?
It is hopeful. I mean, the story of last year was that disconnect on buyer-seller valuation gap. As interest rates rose, there was some kind of confusion and resetting of what is the right price expectation. And so we've been waiting to see how that logjam, how that backlog will start to get unlocked. And when we start to see deals like this come to the market, now there's a new mark, and we can buyers and sellers can kind of get to a closer place.
What is the hottest sector that investors should be watching for deal-making activity this year, too?
Again, I think the places we've seen deal activity, including energy, a lot of oil and gas, consolidation still to come. Healthcare will continue to be an important part of the M&A market. And then those would be the two places where we've seen a lot of M&A activity, and we should continue to, given the underlying industry dynamics and the need for growth in those places.
How much is riding on the Fed's ability and really the fact that they are going to follow through with rate cuts? And we talk about, there's so much focus on that timing of the first rate cut, but when we talk about the impact that is ultimately going to have on deal flow, how much of that really revolves, obviously, around the pace of those future cuts?
Sure. For strategic deal making led by corporates, I think the current interest rate environment is largely baked in. Mm-hmm. So higher for longer is a comfortable place, at least it's an understood place. Mm-hmm. For leverage deal making, so on the private equity side, venture capital, they're going to be more sensitive to seeing the specific timing and size of those rate cuts. So for the strategic M&A market, I think that's why we are starting to see pickup in deal activity as executives get comfortable with the cost of capital today.
How much will investors, do you believe, scrutinize the deal making that does come forward here? I mean, we think even in some of the deals that got announced last year that investors were really kind of sensitive to where companies were putting that capital to work and the companies that they were going after and acquiring as well.
There's quite a difference between what happens at deal announcement and then when we do studies of value creation over time related to M&A activity. I would encourage investors to be looking at the longer term perspective. So if you take a 10-year perspective and you look at, is a company doing at least a deal a year? So that puts that in what we call a frequent acquirer category. They're going to outperform in the long run. And so looking beyond the specific large deal announcement and the overall M&A activity would be key.
The regulation aspect.
Yes.
We haven't brought that up yet. When it comes to the action that we've seen from the FTC, when it comes to the scrutiny that we've seen from the Biden administration, how do you see that, or within your conversations, to the extent that you can share, how are companies, how are potential deal makers thinking about that, and how do you think that is ultimately helping to guide some of those decisions when it comes to acquisitions?
I mean, this has been building for years, and I would say even versus this time last year, we've moved more into a situation of kind of the known unknown. So the landscape is a bit clearer in terms of what kind of actions the FTC or the DOJ may be taking, and that allows executives to look at their M&A roadmap and really consider where might we see regulatory scrutiny, add that lens to their potential deal pipeline. And if there is the conviction and the strategic need to pursue a deal, you can start to take that into consideration. So it's stymieing deal making on some levels. There's going to be certain deals you just don't consider. And then for the small number of deals that get regulatory scrutiny, you need to factor that in.
All right, Suzanne Kumar, great to have you here in studio with us. Bain Company's Global M&A Practice Vice President. Thanks so much.
Thank you.
All right, we've got much more of your market action ahead. Stay tuned. You're watching Yahoo Finance.
It's been a few years since COVID upended the global travel sector. The world is now largely vaccinated, the recession we were all hoping to avoid didn't happen, and the consumer is still spending. Oh, and the Fed is about to cut rates. So, looks like we're poised for another huge year. Well, maybe. But there are more than a few headwinds to contend with, not to mention trends that could reshape the way that you think about your next vacation. Is Delta the airline best positioned to hold market share? Are cruise lines about to hike prices on a stream of never-ending demand? Is astrotourism really the next big hit for 2024? And should you really drive your Tesla from LA to San Francisco? Yahoo Finance's Travel Guide 2024 Industry Insights puts you at the center of the story, looking at planes, trains, automobiles, and any other form of transport you can think of.
American consumers are still spending despite the pressure of sticky inflation. Now, the latest numbers released by Brooks Running showing record revenue growth and all-time high sales in North America. The running shoe brand, which is a subsidiary of Warren Buffett's Berkshire Hathaway, is also getting a big boost from his direct-to-consumer e-commerce business. Sales within that division growing 24% from a year ago. So let's talk about that and more with Jim Weber. He's the CEO of Brooks Running. Jim, it's good to have you here. So we've been trying to figure out the consumer right now, the strength of the consumer, resiliency of the American shopper. What are some of the trends? Obviously, you had a very strong 2023. Has that momentum kept pace here in 2024 so far?
You know, Shauna, it has. We see it accelerating. We had a phenomenal holiday, all-time record year last year, over 20 million units, pairs sold. But our momentum coming into this year is as strong as ever. And we see the consumer very, very strong in the United States. Underpinning that is participation, being active, run, walk, hike. In Europe, more headwinds. You know, I think the economy, I would say, is tentative. But globally speaking, the running category is sort of an it category in athletic footwear right now.
Jim, I'm getting a ton of push notifications from every single company right now about the type of shoe that they're coming out with, a lot of innovation that everybody's putting into the market right now. But then it triggers this question of at what price? Where is the sweet spot in pricing that you're seeing over at Brooks Running?
You know, I think the sweet spot for the dedicated runner has always been this mid price point, which in our industry is about $140. We have the two best selling everyday trainers in that price point, Ghost and Adrenaline. And I think that's still the case, but we're seeing the shoe has never been more validated that it can help you have a better run, a more comfortable run, whether it's racing with carbon plate technology, which we have a phenomenal product line there, trail. And then of course on the roads, cushioning, you know, profiles and the materials and designs have never been stronger. So I think consumers are seeing that, and they're seeing value in premium performance products. It's up 15% last year at premium prices.
Jim, one of the issues, and I know we've talked about it here in the past, is when it comes to inflation and the impact that that has had on your business. I'm curious what those inflationary pressures look like today and whether or not you've had to pass some of that extra costs on to your consumer.
You know, over the last 10 years, I would say, first we had tariffs really putting pressure on our costs. And then, of course, inflation coming out of the pandemic, especially in transportation costs. But in the last 2 years, we haven't raised prices. We've really seen those pressures abate a bit. Still true on the services side, particularly in the United States. But in our product supply chain structures, we're not seeing a lot of inflation pressure right now, and our prices aren't going up on a shoe-for-shoe basis in 24.
What's the hot new material right now, Jim, that's going into shoes, that's going into the Brooks Running experience that you're willing to spend up to make sure you get that material and input that into your own production process so that the sole feels better when it's hitting up against the ground like you were just talking about?
Yeah, fit, feel, and ride and cushioning is a universal truth for so many people. Nitrogen infused our DNA midsole platform. We've never seen better characteristics on cushioning, on durability, and just comfort, you know, stride after stride. So, you know, nitrogen within our whole midsole platform, plus carbon plates in our racing shoes, I think they've transformed the shoe. If you haven't tried a good running shoe in the last 2-3 years, ours have gotten dramatically better, and I think the consumer is seeing that.
Jim, how are you navigating some of the headwinds, the challenges when it comes to the larger rivals, right? Just given the fact that you are a smaller player within a very competitive landscape, how does that look like, or what does that look like heading into 2024 versus some of the competition that you've seen in the past? And I bring that up because Lululemon, one of the competitors out there that recently entered the men's footwear space.
It has never been more competitive, and that's not new for us. You know, athletic footwear is one of the largest categories, you know, in all of the consumer world, and it's global. So we've competed against much bigger competitors for the last 25 years plus. But I think it all comes down to winning the customer, you know, and they're so driven to innovation and performance and quality. And so we strive every day, literally, to build a better experience for runners. And they have choices. Oh my gosh. But I think we're executing so well right now. 10 of our styles are getting updated with new innovation in 2024. So we're on the offense. And, you know, I think the competitive side of things is real, but the customer is the one who's going to decide and make the decision. We're still the #1 brand with runners in the United States, and we expect to continue to grow share in running in 24. So, but it is uber competitive. We just think we're well positioned to compete for our share of new customers.
Jim, this conversation has been our reprieve from Nvidia, but I'm going to take it back there because there's some AI energy that's perhaps out there within the shoe landscape. Is AI going to design and put together, develop the next shoe that Brooks Running's being able to put out there into the market and cut down on some of the time in the traditional research and development? How does that reshape the shoe market?
Yes, yes, and yes. Last year, our design team in footwear led almost an AI initiative of bringing those tools in to really inspire designs in 2025, 26, and beyond. So we're using it already in product design, and we're just seeing tool sets being created across our business. So, like everyone else, I think AI is going to make us faster and smarter, and that needs to happen in our supply chain because our supply chains are long right now. We'd like to compress that, as we say, long is wrong, and the lead times in footwear are very long.
Jim, when it comes to headcount specifically at your business, do you see it potentially offering or altering your workforce to some extent?
We don't see that. We're a small global brand at about $1.3 billion. We've got 1,300 employees, and we're working really hard to make this brand relevant to runners all around the world where we are sold. And so, that team dynamic is just who we are as a brand, and we've got to bring it alive in real life. And we got to where people run, and we've got to bring it alive digitally. And so I don't see it allowing us to, work with a lot fewer employees, but I think we're going to be faster and smarter.
Jim, what shoe is the Oracle of Omaha wearing today?
I hope he's waking up and putting on our new glycerin, because I think it's one of the best shoes we've ever built.
Okay, no doubt. I know you guys have the shipping info, and you probably know which ones went to them last. So you've got some good insight there. Brooks Running CEO Jim Weber, thanks so much for taking the time as always.
Thanks for having me.
Certainly. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Travel is poised for a comeback. Wait, wasn't that last year? Well, we're poised to go into overdrive at least. High ticket prices, dwindling savings, and all that recession talk didn't slow red-hot demand for planes, trains, and leisure spending across the board. Air travel, for one, rocketed back towards that all-important pre-pandemic level with no signs of slowing down in 2024. But with a new year comes new challenges. Will all that pent-up demand finally get tapped out? Will passengers finally get priced out? And will much publicized issues for giants like Boeing put a crimp on demand? And then there's the mighty seas, of course, the likes of Carnival and Royal Caribbean. They were on cruise control last year. The sector was the outperformer, but will operators increase rates for those still riding the post-pandemic fervor? Don't discount geopolitical risks either. Their impact on the price of fuel. Oh, and a host of new trends from astro to music tourism. Yes, we're talking Taylor Swift. There's lots to digest, but Yahoo Finance will tell you exactly what you need to know. Tune in to Yahoo Finance's Travel Guide 2024 Industry Insights beginning February 26th. Roku shares down nearly 7% in the last 2 days since Walmart announced its acquisition of Vizio. But our next guest says that this share price reaction may be overdone. Laura Martin, Needham & Co., senior media and internet analyst, joins us now. Laura, great to see you here this morning, and thanks so much for taking the time. I mean, really fascinating rundown. You pointed to 10 potential upside value drivers from this deal. We won't run through all 10 right now, but one of the huge things you pointed to with Roku here, it really goes back to how they're going to be able to drive some of that advertising revenue here. Take us through part of that thesis here.
Right. So my thesis here is that when Walmart is reacting to Amazon, Amazon introduced ads to all of its 200 million Amazon Prime Video subscribers, and now it's going to take connected television ads on a big screen and connect them all the way down to the purchase. On e-commerce platform, Walmart has now bought Vizio because Vizio has $500 million of ad sales on connected televisions, and it's going to use Vizio to sort of keep up with Amazon. You'll buy an ad on a Vizio TV, and then Walmart will tell you whether any consumer bought that product in the real world in one of their 4,700 stores or on their e-commerce platform called Walmart.com. That means who they're targeting for ads is totally different than the past of the Vizio's past, because Vizio used to be a direct competitor to Roku, and now Walmart's going to use it to do a totally different thing, which is tie ads to purchases, which competes with Amazon more directly. So that's a positive for Roku because it sort of leaves it as a monopolist in the marketplace for advertising.
So Laura, what does that then tell us about the potential gains here for Roku within that market in terms of market share and what that could potentially do for their revenue then in the longer term, given the fact, if you're right here, that Vizio won't be as strong of a competitor?
Right. So, I mean, Vizio is going to do 500 million of revenue. So that's a pretty, like, let's say it all moved to Roku. That would add about 30% to their ad revenue, just the Vizio piece, not to mention what they're already growing on their own platform. So that would be a big upside driver, I would say.
Additionally here, you talk about the OTT focus and the pros and cons of single focus companies. I mean, when we think about some of the competition within this landscape, there's been significant OTT consolidation that we've seen. How does Roku kind of fit into that, or how do they kind of retain their own market share within that?
Right. So the big competitors here are like Samsung, LG, Vizio, which will now be gone, and Roku. And they're all owned by these huge conglomerates other than Roku, which is owned by a single founder, really fast pivot times, really fast product upgrade times, because there's one guy that can make a decision. That used to be true of Vizio. Now being owned by Walmart, we would guess that decisions and changes and market reactions are a little bit slower because Walmart's processes are probably a little more refined than these founder-led companies like Roku and Vizio. So I think that's good for Roku because it's the only one that only focuses on streaming, and it's an arms dealer, meaning it takes 20% of the revenue generated on the Roku platform from Netflix, from Peacock, from Disney. It doesn't sort of care who wins the streaming wars because it takes 20% of their revenue sort of no matter what, no matter who wins or loses.
Laura, I want to switch gears here from Roku and talk about one of the other big stories within your space this week, and that's the fact that Fubo TV is suing Disney, Fox, Warner Brothers Discovery over that joint venture. We talked to the CEO of Fubo TV, David Gandler, yesterday, and he was saying he thinks the joint venture is anti-competitive. He's worried about pricing, the fact that it's going to drive up prices for customers. I'm curious to get your thoughts just on the cost aspect of it and what it could mean for subscribers.
So I actually think this is a really clever negotiating ploy by David. The first thing to say is the DOJ this morning launched an investigation into the joint venture. I think that would have happened without Fubo's prodding, but good for them. Regardless, the DOJ is now looking into that deal. For Fubo, it's a very clever negotiating ploy because always in television, there's been volume discounts. So Comcast, which is was largest distributor, got the lowest price for ESPN or the Food Network or A&E Network. And so Fubo, which is small, it only has 1 million subscribers in America, they got the highest price. And the startups get the actual highest price because they don't even have a subscriber. So what Fubo's saying here is that that is anti-competitive, that it stops competition because little guys have to pay more to enter the market. So I think what he's trying to get out of this is not really, he's trying to get DOJ focus, check the box, done. And then he's trying to get parity on fees so that he doesn't have to pay more than Comcast or Charter or somebody bigger. That's sort of a smart trade to me.
What is the likelihood from your perspective that this partnership actually makes it into the consumer market for people who want to engage in sports streaming in a bundle capacity in this way?
So I think it gets passed because think of the precedent. If the government can actually enter contractual agreements between 3 companies, where does that end? Companies are trying to run a business, they're doing so. I think they get it through, but they have conditions like they cannot bid as a group. They have to bid separately for sports rights, which would have been a huge upside value driver for that entity. If I'm the government, I don't let them do that. So I do think the government put conditions, but at the end of the day, this is a contract of operating companies. It's not even that big a part of those companies. It would be a nightmare from a court precedent point of view if suddenly they could determine what contracts companies could sign.
There's also been lots of talk just about further consolidation within the space beyond bundling when it comes to some of those smaller players. We've talked a lot about that notion in the past. How inevitable is this? And when it comes to the timing of some of those deals, when do you see or when do you expect to see more movement?
So I think you've also seen, in addition to this deal, you've seen Peacock and Paramount being rumored to get together via joint venture or contract. The problem with Washington, D.C. right now is the regulators will not approve consolidation among big companies. So the CEOs are getting around that by doing these contractual deals that give them economic upside from combining, but they actually don't run afoul of, they don't have to go in front of the FCC or the FTC or the DOJ. Which is why they're trying to do these contracts. So I see more contracts unless we get a Republican president. And then all those agencies, commissioner heads change, and then you could get consolidation, which is what needs to happen in the media space.
All right, Laura Martin, always great to get your insight. Thanks so much for joining us here. Laura Martin of Needham & Company, thanks. Well, let's stick with the streaming space because we got a lot to talk about. Warner Brothers Discovery, ESPN, and Fox reaching an agreement for that joint sports streaming venture that we've been talking about, leaving investors questioning the fate of pay TV. But there's a new report out from S&P Global saying that fears may be overblown. Yahoo Finance's Alexandra Canal has the details for us. Ali, a little overblown, I guess, at this point?
Yeah,
potentially.
From their perspective. And, you know, there's been a lot of talk about what this skinny bundle means for the future of linear TV, especially because all of these companies, Warner Brothers Discovery, Disney, Fox, they have a lot of exposure to linear networks. And that bundle does help fund a lot of those streaming initiatives. So the fear here is that are we going to pull customers away from that pay TV bundle? And could that impact profitability, which is one of the reasons why we sometimes see these shares move lower on the heels of these streaming centric announcements. But S&P is arguing that these fears are overblown and that the joint venture, if it's priced correctly, could actually add pay TV customers. So it all comes down to pricing. If it's priced too high, it's not going to appeal to the cord cutters. If it's priced too low, that could potentially cannibalize existing pay TV users. So S&P is anticipating a price point between $40 to $50, but it's important to remember that this is a skinny package of linear TV networks, and consumers will only have access to games and packages that these companies have the rights to. So if you're a pay TV subscriber, you're likely a pay TV subscriber because of sports. You see the value in having access to the full slate of content. You probably aren't going to opt in for this skinny bundle because you want as much content as possible. If you're a cord cutter, you probably either don't care about sports or you just don't want to pay that high price point. So I think there's an interesting argument here that it all comes down to what ultimately this is going to be priced at when you think about who this is going to attract the most. And there's a lot of unanswered questions here, not only with pricing, but also with FTC, antitrust. Obviously, we have that Fubo lawsuit. So a lot of question marks and answers that these companies are going to have to ultimately come up with.
Well, I have another question mark for you. What does the skinny bundle mean for Disney's flagship ESPN service as well? I mean, that's set to launch in 2025.
Yeah, I think it could potentially give Disney some really interesting insights into who the customer is, who wants to pay for an over-the-top sports streaming bundle, what the price point could potentially be, which is another reason why if it's priced too low, that could be a net negative for Disney because it potentially puts a ceiling, a cap on what that pricing could be. But Disney could also see some interesting insights when it comes to marketing, when it comes to consumer demand. So this could be a pretty good test, I think, for Disney as it plans to launch that ESPN flagship service in 2025.
And so, Allie, it's going to be a test here for Disney, but also, do you think it's a test right for the broader industry as well, just in terms of how successful this is going to be, what it's going to do for future bundling, and really giving us a better idea of what the consumer at the end of the day is interested and willing to pay up for?
Absolutely. It all comes down to demand, right? Are customers going to be interested in something like this? And if they are, who is that target audience? Then you think about the companies that are left out of the bundle. You have Paramount, you have NBC Universal. This could potentially hurt them in the long run because the assumption is that, you know, the ABC and Fox affiliates, they're going to get paid for being a part of this skinny bundle. So I think that's why we heard that one rumor, that one report that Peacock and Paramount Plus are potentially thinking about joining forces. So this is going to lead to a lot of interesting moves among all of these companies and potentially more consolidation.
All right. Allie, appreciate the breakdown there. We're going to be watching very closely to see if this goes through and what type of challenges it faces as well. We appreciate it. Thanks. Let's take a quick check of the markets here as we are nearly 90 minutes into the start of trade. We've got the Dow, the S&P 500, and the Nasdaq up on your screen right now. The Dow higher by about 0.7%. The S&P 500 seeing gains of 1.5%. And the Nasdaq Composite saying, hold my beer. You think that's something? 2.2% in the green right now for the tech-heavy Nasdaq, driven heavily by, we know, the AI trade, Nvidia, off of the back of those earnings, which have now pushed Nvidia past that $1.9 trillion market cap. It was, at this point, it just seems like a stone's throw from $2 trillion. We'll see it eventually when we do get to that marker here. And then on the sector front, we're mixed, but more leaders than laggards right now.
Yeah, certainly. It seems like nothing stopping Nvidia and really the AI trade, at least for today, at least over the last several months. And when it comes to that optimism, we were talking at the top of the show with Paul Meeks and Dan Ives about the moat that Nvidia has, but the fact that we are still in the very early innings of AI adoption.
Yeah.
So what that growth is going to potentially drive here in terms of wider adoption, obviously, going forward, and what that could mean for a lot of these potential beneficiaries.
Nvidia right now feels like Shaquille O'Neal running full speed down a basketball court. Who's going to step in front of it right now?
Yeah, nobody.
That's all for us today. We stay for the analogies here, I suppose. We'll see you tomorrow. But Kiko Fujita and Rochelle Akufo have you for the next hour.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's what I'm watching so far this morning. Nvidia, of course, taking center stage after topping Wall Street estimates for the fourth quarter. The chipmaker issuing guidance well above expectations. But can it continue to deliver on the booming AI demand?
And speaking of artificial intelligence, Reddit reportedly inking an AI content licensing deal with Google. That's at least according to Reuters. We're going to have the breakdown later this hour.
And time to double down on your finances. As tax returns make their way to millions of Americans, the opportunity arises to utilize returns to build your wealth. We'll have more on that coming up ahead.
First, though, time to take a look at the markets 90 minutes into the trading day. And yes, they are up. The Dow up more than 200 points. The S&P 500, by the way, surging to an all-time high, up 75. And the Nasdaq, the biggest winner on the day, 342-point gain is what we're looking at so far. Of course, all of this is about those Nvidia earnings, and we are seeing the tech sector up in a big way today, up well over 3.5%. We'll continue to watch that. And the broader tide or broader gains we're seeing on the back of those better than expected results from Nvidia. Let's take a look at where the treasury markets are trading right now and seeing where yields are on the back of those Fed minutes that came down yesterday, really pointing to the fact that the Federal Reserve not necessarily in a hurry here to cut rates. And we are seeing the 10-year yield down at 4.31%. The 30-year yield is at 4.46. Let's get into the biggest story of the day, and that is, of course, Nvidia. Shares of the AI powerhouse surging today and pulling markets up with it after reporting a massive sales growth in its fourth quarter and issuing guidance well above expectations. It isn't just boosting stocks in the U.S. Of course, we are seeing the global trade on AI. European stocks and the Japanese Nikkei index also jumping on this report. And worth noting here, Rochelle, we did see the Nikkei over in Japan blowing past that record they set back in the 1980s. Of course, this isn't just about Nvidia, but we did see chip makers up broadly here. Worth pointing out where they are: Samsung, SK Hynix, TSMC, Tokyo Electron, equipment maker Advantis, which supplies to Nvidia, also seeing a big pop. And then, of course, SoftBank, because they have a 90% share here in ARM, also gaining. So really a broad-based global gain here for chip stocks on the back of really what was a blowout quarter, another blowout quarter from Nvidia.
I mean, and you have to think, I can't remember the last time that one ticker, one stock could have this much of a rippling impact really across all markets here. We mentioned the Europe Stock 600, which is that index is equivalent to the S&P 500 here in the US. So it's a broad market makeup, large, mid and small caps. But when you look and dig down into the Stock 600 tech index, some of the names being impacted include ASML, a semi maker, as we talk about Samsung here, selling off its remaining stake so that it can focus on even more aspects of the chips arena here. And when you look at, you mentioned Samsung in terms of competing with SK Hynix, these high bandwidth memory chips, these are the ones that support Nvidia's accelerators in training AI. So when you look at sort of the tentacles of everything that's attached to Nvidia, as well as what services it, this really seems to be something unprecedented, Akiko.
Yeah, and Rochelle, it's not just about the quarter they reported. Obviously, that's backwards looking. It is about the demand that Jensen Huang, as CEO of NVIDIA, has said is coming. In an interview, he said specifically, we're in the first year of a 10-year cycle of really massive AI adoption here. So if this is the first year, you got to wonder where investors think this could go. There is, of course, the broader concern about capacity. That's something we're going to get into with our next guest. But as it stands right now, it certainly feels like there's no stopping that demand picture for NVIDIA.
Indeed, we'll continue to see how some of these other companies jockey for position on the back of this. Well, as we continue to dig into this, Nvidia, of course, blowing minds once again, fueling further hype around AI with quarterly sales triple what they were a year ago. Nvidia CEO Jensen Huang saying, quote, accelerated computing and generative AI have hit the tipping point. Demand is surging worldwide across companies, industries, and nations. Well, joining us now is Dan Flax, Neuberger Berman Managing Director. Dan, thank you so much for joining us. So in terms of the demand that we know is there, what about the capacity to meet that demand? How confident are you on that side?
Good morning. I expect Nvidia and its partners to continue to add capacity in the months and quarters ahead. If we think about what's going on here, Nvidia's solutions are empowering others, for example, cloud companies, to expand their business, create new revenue streams, and ultimately grow. And so this broader story about Nvidia's platform, its ecosystem with millions of developers, remains vibrant. I think we'll see good growth through the rest of this year into next year as supply continues to come online.
Dan, there are already concerns about the valuation of this particular stock going into earnings. Now, right behind Apple as well as Microsoft. Given the numbers that we got yesterday, does the valuation match where the company is? You see it pushing even higher.
We think the stock remains attractive here. If we think about the next couple of years, driven by the product cycles, Nvidia should generate significant free cash flow, and that free cash flow will continue to grow in our view. And so when we look at the valuation in that context relative to the growth prospects, I think the stock remains attractive here. To be sure, these businesses are cyclical. There are, of course, product cycles, macro cross currents, but the underlying drivers of the business remain healthy in our view. And I think we'll learn more at the company's GTC conference next month about the product roadmap, which helps lay the foundation for additional growth.
And to that point, because you would think that the idea is that in that 10-year cycle that Jensen Huang was talking about, some of these costs should be expected to come down. How do you then gel that with what we might see in terms of the product roadmap, as well as how they plan on executing as you see other companies coming in trying to really get on board, especially Intel here, and really try and have some competition here?
I think competition in this market will remain fierce. The key for Nvidia is to continually drive value for their customers in new areas. So as they bring out, for example, their new architecture for the data center likely to be introduced next month, the performance, the capabilities, the features are going to enable Nvidia's customers to add value in their businesses. Think about areas like drug discovery, fraud detection, climate change, really the re-architecting of the industrial landscape as you marry the physical and the digital. And so the growth and the use cases, I think, remain attractive. If we look at what some of the other companies are doing, I think AMD, for example, has an important role to play. CEO Lisa Su and her team are developing and continuing to broaden out their product roadmap in areas like the data center GPU market. I think we're going to see good growth from there. What we saw from Intel yesterday in terms of their foundry strategy, I think CEO Pat Gelsinger and their team are continuing this multi-year investment strategy. I think as we saw with their Microsoft customer announcement, Intel has an important role over the next several years to play in the foundry market and more broadly, certainly in the data center AI market.
Particularly in the foundry market, Dan, how quickly do you think Intel can ramp up the production? Obviously, they're trying to take away some market share from TSMC, which is, produces most, if not all, of NVIDIA's chips right now.
I think it will take several years. Intel has to demonstrate continued improving execution on its roadmaps, and you're seeing that under CEO Pat Gelsinger. I think what's important, though, is the foundry market's expanding. We're seeing the increased geopolitical dynamics shift how big chip customers want to tap into supply. We're obviously going to see a lot more growth here in the United States in terms of chip manufacturing capacity. And so Intel, I think, has an opportunity to grow. We'll have to see over the next few years how they execute, and I think it will take time and require a significant level of additional investment as we think about the back half of this decade.
And certainly, Dan, when we think about the high-performance chips, all roads, at least at this point, still go through TSMC. Even on the foundry side, roughly half of the global semiconductor foundry market in terms of revenue still is dominated by TSMC. What do you think are the biggest headwinds that people should be aware of in the growth story when you do have such a concentrated player here?
Well, I think with respect to TSMC, they continue to execute very well. They have invested alongside of their customers and have a multi-year roadmap, which they're continuing to perform well on. I think with respect to Intel, the goal for them is to demonstrate, and we saw that with the Microsoft customer announcement, that they can deliver for their customers in Foundry and at the same time continue to advance their own businesses. And so Intel, it's going to take time. The key is that the market's growing, and the strategic importance, really the tailwinds for the foundry market, are, I think, going to be substantial over the next several years. And so we are going to continue to watch closely in terms of Intel's ability to execute that. But again, it remains very early for Intel.
Dan Flax, Neuberger Berman, Managing Director. It's good to talk to you, to get your insight. Appreciate the time. Time now to take a look at today's trending ticker. And today we're watching shares of Novavax surging after announcing it will settle a dispute over a canceled COVID vaccine purchase agreement. The pharmaceutical company terminated a purchase agreement with global vaccine organization Gavi back in 2022. Now Novavax could pay up to $475 million to the organization over the next 5 years as part of the settlement. So $475 million, Rochelle, certainly a significant number here, but that's been the big overhang, the clearing of this uncertainty really providing a leg up for the stock today in the session.
It's true. And we know that Wall Street had been really waiting for a conclusion to this, because you saw Pfizer and Moderna pushing ahead. They got to have their post-pandemic story here. There was some certainty there. Now Novavax gets to join in that discussion. They've been pushing ahead with trying to do some cost cutting. It was hard to do when they still had this cloud hanging over them. So it'll be interesting to see then not just what they do in terms of now that they have this potentially behind them, but now how they compete in the post-COVID world in terms of what's going to be their differentiator versus some of these other big pharma names that have already had a head start as a result of not having this hanging over their heads. All right, well, do stay with us, because
so much
coming
of
up,
these
the stocks. Oh, go ahead, Akiko.
Well, I was just going to say, so many of these names that we came to know during COVID, really trying to find that post-COVID story, right? Finding their footing. Novavax, at least that stock down about almost 3% on the year so far.
Indeed, we'll see where it goes from here. All right, well, stick with us. Coming up, stocks powering higher as Wall Street celebrates Nvidia's blowout quarterly results. Is this the bullish market tone here to stay? More on that next. The S&P 500 and the Nasdaq surging on the back of those strong quarterly results from Nvidia. The chipmaker's blockbuster earnings eclipsing concerns about the Fed's caution over interest rate cuts. Here with more on the market action is Marianne Bartels, Sanctuary Wealth Chief Investment Strategist. Good to have you joining us on the show here. So clearly the FOMC minutes, you're very welcome. The FOMC minutes not getting the usual reaction, of course, overshadowed by what we saw with Nvidia. But I want to dig in here in terms of how markets should be taking these data points, especially when we look at the Fed saying, look, we're comfortable holding rates at this point.
So the way I look at markets and whether or not, markets can go sustainably higher, it's all about earnings and whether or not companies can produce earnings. So has the Fed created a backdrop where we can have economic growth where companies can produce earnings? And the answer is yes. And we are seeing the inflation data come down. CPI is coming down, but it's a little bit bumpy. If you look at core PCE, the Fed's favorite measure, it's already at a 2 handle at 2.9, but nothing moves in a direct line. But we feel confident that throughout this year, you're going to continue to see inflation come down. It's not necessarily about the interest rates. If we look at last year, the market was looking for the Fed to cut rates. All of last year, we got 0 cuts, yet we had a phenomenal market. And again, the market was looking for 7 rate cuts. Now they're looking more on the range of about 3, but we're powering higher because we have a backdrop where companies can make earnings. So I don't think it's all about the rate cuts, although it would certainly benefit, I think, the markets if we got a little bit of easing from the Fed.
If it is about earnings, of course, investors getting a big bump on the back of Nvidia's results. We're talking about triple-digit growth here, and yet you have to wonder, as Nvidia's stock pushes higher and others in the space also push higher, are we reaching a point where things are a little frothy? Does that concern you at all, or do you think the growth that we have seen out of these companies justify the valuations?
I personally feel the growth that you're seeing justifies the valuations, and what we've actually written is when you're in a secular bull market, which we believe the equity markets went into a secular bull market in 2013, PE multiples expand. Although we all love to buy value and low PEs, once you come off start that secular bull market, PEs never come down to the level where they started from. So we're actually looking for PE multiples to continue to expand, and we think they can actually expand into 2029 and 2030. We think PE valuations on select companies, particularly in technology, are going to go to levels that are really going to shock investors. But for today's market, given the earnings and the earnings momentum of some of these tech names, particularly in semiconductors, and as you mentioned, Nvidia, we think the valuations are strong enough that you may even see them go higher based on future earnings.
So then with that in mind, looking at your S&P 500 target, you're looking at between 5,200 and 5,400. Can it reach that, though, without a more meaningful broadening of the rally beyond these concentrated tech stocks?
Well, I think that people are underestimating the broadening of the market. There is some broadening. It's not just about the Magnificent Seven. We have, stocks in consumer discretionary hitting new highs, particularly in the housing part of the market. You're seeing new highs in stocks in the industrial space. So you are getting a select amount of broadening. It's not just the Magnificent Seven, but what we pointed out is in the Magnificent Seven, those are the companies that have actually been reporting the earnings. And that really gets to growth versus value. When earnings are scarce, the market shifts to growth because portfolio managers and investors want to own the companies with the earnings, but there's not enough of them. So that's why you get the PE multiples expanding, is because everyone is chasing the companies that do have the earnings. But we are seeing a broadening out, but you're not getting it in terms of market cap. Small cap is still lagging, and we still think that they're in a secular bear market. You're not seeing it in the value pockets like energy and in financials, particularly the banks. And we think there's fundamental reasons why that's happening. So we think that the cycle will stay growth. You will have select broadening out, and that this whole new evolution in artificial intelligence, AI, is meaningful. And you're seeing that through NVIDIA by producing the earnings. This is not 2000. We're seeing people compare this to 2000. It's nowhere near 2000. Where I think this is more like 1995, where computers really came into the market and started to create productivity enhancements. And then you had the internet come in, and you had this massive move in the markets from 95 to 2000. So we think this is very early in the cycle, and that AI is going to add to productivity, and that will actually even help on the valuation basis.
Marianne, really quickly, what do you think is the most overlooked trade right now?
Well, I think housing, we just got some great numbers. There's more cash buyers than we've ever seen. And I think select parts of the industrial space based on infrastructure.
I appreciate you giving us your biggest takeaways there. Marianne Bartels from Sanctuary Wealth, thank you so much for joining us this morning.
Thank you.
All right, coming up, we dive into exactly what Elon Musk's biggest obstacle to reincorporating to Texas is. And reportedly, a social media giant is teaming up to train Google's AI model. We'll have more on this next.
Well, Tesla CEO Elon Musk's relationships with people on the EV maker's board of directors might present a challenge to his push to reincorporate the company from Delaware to Texas. Let's bring in our very own Alexis Keenan for more on this story. Alexis.
Hi, Akiko. Yeah, so I've been exploring whether Musk, Tesla will need kind of a fresh crop of board members in order to effectuate and get through a suggestion and vote on a move of Tesla's incorporation from Delaware to Texas. And the corporate structuring experts that I've been talking to, they say that they think the company very well might need some new members. Now, one major reason is that the Delaware Chancery Court that invalidated that whopping $56 billion pay package, CEO pay package for Musk, they did it by applying this really tough legal standard that even at Musk's 21.9% control of the company at that time, said that Musk controlled Tesla, and that really put a burden on Musk to have to prove that that shareholder vote for that pay package was fair. Now, the judge said it wasn't, and that's because the judge concluded that Musk had, quote, thick ties with some of these directors that negotiated this compensation, and also that Tesla's proxy statement that recommended this pay package, that it didn't adequately tell investors about whether the board members who recommended it were independent versus not independent. They said it wrongly said that the directors were not independent enough from Musk. So in order for the management to now recommend this shareholder vote on an incorporation in Texas, they're going to want to avoid this really heightened legal standard. And the way they could do it is to avoid these types of relationship conflicts. So take a look at Tesla's current board. Now it's different from what it was at the time of this pay package. And you kind of start to see some of the problems here and the limitations of who in this group might be able to make a recommendation for this. You have Musk, who would need to abstain from this vote. You have Robin Denholm, the board chair, that the Delaware judge said lacked independence. Also, Aaron Price, Musk's close friend. Also, the Delaware judge concluding that he lacked independence. James Murdoch, CEO of 20th Century Fox, also a friend of Musk. Then you have Kimball Musk's brother. You have J.B. Staubel, Tesla co-founder, and Joe Gebbia, Airbnb co-founder, as well as Kathleen Wilson Thompson, former executive at Walgreens and Kellogg. So there may be some of that group that would be considered independent enough, though some of these people haven't been tested in a fresh lawsuit. And certainly shareholders could come back and say that they didn't think an action involving Musk or something that Musk wants, presumably for his benefit, a move to Texas, that it might not be fair. So even though without a conflict, though, this would all have to get through a shareholder vote, and it would have to be a majority of Tesla's minority shareholders.
So for people who are trying to look at some of the other precedent that's out there, another case that I know you were following in Delaware was decided last week that gave the green light to TripAdvisor's move to Nevada over a legal challenge from shareholders. How might that impact Tesla's decision to try and incorporate in Texas?
Yeah, Rochelle, so this other case, it was a pending case, now just decided this week, and it very well might have an impact on what Tesla decides to do here. What happened was the shareholders similarly challenged this company, TripAdvisor, went ahead and voted on a move from Delaware to Nevada, where it has more friendly rules for board directors in terms of liabilities that they can take on if they're challenged. Now, that, though, decision said that the company could go ahead, move to Nevada, incorporate there. But the real kicker here is that the judge said the lawsuit, it can continue. And if during the pendency of that lawsuit, the shareholders who brought it are able to show that they were damaged by this move and that they should receive some sort of monetary compensation, that would allow the case to go forward and for the shareholders to get really their day in court. So all of this, a lot in the mix here, yet Tesla has yet to make any move that we've seen to put forth a recommendation to its shareholders. But so much to consider here, and certainly would be a big move for Tesla if it does decide to go ahead with a suggestion here.
Well, I know you'll be following all of that action for us. Appreciate you breaking all of that down. Our very own Alexis Keenan. Well, taking a look at Reddit content that might be used to train Google's AI models. That's according to a report from Reuters. And sources say the contract is worth about $60 million a year. To break this down for us, Yahoo Finance reporter Dan Howley is here. So Dan, this is interesting timing. I mean, we know that Reddit is supposed to have its IPO offering at some point soon. But what do we know about this tie-up here?
Yeah, this is basically obviously another revenue stream for Reddit to try to mine here. That's $60 million a year, and I think for them it's something that is an opportunity to ensure that their data just isn't being mined for generative AI training. It's something that a number of sites have brought up, have said that we don't want our data used or have agreed to having their data used. Some are fighting lawsuits about it. Some are jumping in wholeheartedly. I know, obviously Reuters is one of them as well that's getting into the AI game. And it's going to be something that a lot of sites are going to have to eventually come to terms with. Now, when it comes to Reddit, it's different than a media company, right? They're a social network. Having their content mined is a little bit different than what you would get from something like our site, for instance, right, where you're getting live news. There are writers on there who may or may not want their content taken and used for training, or an overall company that may or may not want its data taken and used for training. But for Reddit, it seems that this is a way to train on essentially the zeitgeist, right? This is where people go to talk about everything from sports to, well, there's the Wall Street bets, to games, movies. A lot of talk about Dune right now, Dune 2. I never saw the first Dune. I think I have to do that this weekend, maybe. Although I had a friend that said it was terrible. I don't know. Anyway, Reddit is used, for any number of things. And I think this is a way for, obviously, it to be used, that kind of content to be used in mind, and maybe give a broader spin to generative AI learnings. Perhaps provide more pop culture content for training. But it's certainly going to be something that's far different than what you would get from a standard news site. And because it's social media, not everything on there is factual.
Dan, what does this mean for Google? I mean, they need all the data they can get. I mean, how valuable is the data coming through from Reddit?
Yeah, I mean, look, they absolutely need as much data as possible. They say that their current high-end model, Gemini, is as good, if not better in certain circumstances, than OpenAI's latest version of GPT. And so, if they can further train up what they have to offer as far as Gemini, that's absolutely huge. And it's Google. They have basically all of the data under the sun. Why would they need more? Well, the more data you pump into these things, the smarter they get. Smarter in quotes. They're not actually smart. But I think when it comes to something like Google, they're fighting a big war here with Microsoft over who is the AI leader. They're the ones that created the transformer models to begin with at Google. But Microsoft really kind of stole the lead when it had invested in OpenAI. ChatGPT hit, for consumers around November of last year, in 2022. And they've just been off to the races since then, putting it into all of their products. And Google's doing that as well. They're catching up. I have a version of Chrome that's running generative AI when I do a regular Google search. But when you hear about AI at this point, it's all Microsoft, Microsoft, Microsoft. So if Google can grab any advantage at all, it's going to try to do that. And this is part of that attempt to gain an advantage.
Yeah, and it's an interesting point you raise about it being about sort of tracking the zeitgeist versus, say, the accuracy of something like, like a traditional news site. So obviously, AI is good as the data it's trained on, so we'll continue to see how that plays out. Appreciate you, as always, our very own Dan Howley. All right, coming up is Walmart's 3-for-1 stock split purely cosmetic. We'll dive into that next. EV earnings continue to underwhelm. Shares of Rivian falling after full-year production figures came in far below estimates, down more than 26%. Rival Lucid similarly reporting weaker guidance for the year on waning EV demand, also under pressure as well. Now, a new report by Cars Commerce says despite some waning demand for EVs, there is still interest in that market and that prices may become more affordable this year. Here with more on the report is Rebecca Lindland, Cars Commerce Senior Director of Industry Data and Insights. Thank you for joining us. So give us some context here. Given some of the price cuts that we've seen from some of these EVs and some of what we're seeing in terms of like reduced production, is this the year then to perhaps buy an EV? Are the prices attractive enough?
Yeah, so Rochelle, thank you so much for having me on. I think it absolutely is a year to buy an EV, both new and used, because we're seeing growth in inventory and supply of new EVs actually on the dealer lot, which is a big change from past years when it was sort of this haute couture sort of feel. Now it's ready to wear. You can go and get an EV and drive it off the lot. We're also seeing increases in used electric vehicles. So you definitely have choices now, and you have an opportunity to test drive that vehicle before you make the commitment to purchase.
Rebecca, this of course comes at a time where we're seeing a little more hesitation from drivers to make that transition to electric. What are you finding about how much consumers are willing to shell out for an EV, whether it's new or used?
Yeah, so Akiko, it's really interesting. We actually are seeing increasing interest on cars.com, our marketplace site, for electric vehicles, but we're actually seeing twice as many buyers shopping for hybrids and plug-in hybrids. And I think part of this is due to the fact that consumers really are interested in plug-in technology. They're interested in getting better fuel economy, but they don't necessarily yet feel comfortable going to a full electric vehicle. So instead, a plug-in hybrid provides that middle ground and a great transition. You get used to plugging in your car, just like we got used to plugging in our phones. This way, a plug-in hybrid allows that transition for consumers.
Is it just about the infrastructure, though? Are you finding that costs, now that they're coming down, is also generating more interest? And what's that price point?
Yes, it certainly is both pricing and infrastructure. Consumers are continuing to be concerned about where are they going to charge this? How much range is there? We encourage consumers to look at installing a home charger if they're able to, or talking to their homeowners association about installing them. As far as pricing, though, we're definitely seeing a softening, as you mentioned, of both of new and used EV pricing. We're also seeing opportunities to lease these vehicles. And of course, we're seeing the new regulations come in, the $7,500 tax credit, which now is actually applied at the showroom versus waiting for your taxes. So they've simplified that process when it comes to acquiring an electric vehicle.
And Rebecca, in terms of the trends that you're looking at, because we know that for a while, it used to be all about the compact SUV, but then we saw a shift in that looking at pickup trucks. I wasn't sure how much of that was people looking perhaps for Cybertruck alternatives and things like that versus if that's translating into actual sales.
So we're actually seeing, some of the top interest on the site continues to be those pickup trucks for sure. And, but consumers are looking for all different types of vehicles. With electric vehicles, you've got options from a host of manufacturers, not just the Teslas and Rivians as you're showing now, but we've got the Ford F-150 Lightning, which continues to be very popular on the site. So we're still seeing a lot of interest in those compact SUVs, as you mentioned, but also in these full-size SUVs. We're also seeing consumers interested in, getting a good buy. One of the things we're looking at is that the market is moving towards a buyer's market. We're starting to see more supply. So that's absolutely one of the trends that we're watching really closely.
And in terms of the most popular, the best-selling brands in both luxury and mass market, we're looking here at fastest selling, so Toyota for mass market, Lexus for luxury. Why do you think they're so well positioned?
So I think that they always have had a good handle on balancing inventory with demand. And, typically the ones that you're showing there, they tend to say, they constrain supply a little bit, and they really are great at measuring that inventory, how much is on the dealer lot versus the consumer demand. So, and again, there continues to be a tremendous amount of interest on Cars Marketplace for the Hondas of the world, Toyotas. I think BMW is second when it comes to luxury, right behind Lexus. So there's a lot of activity for these both Japanese brands, European brands. The luxury market continues to do quite well.
Rebecca Lindland, Cars Commerce Senior Director of Industry Data and Insights. Good to have you on today. Thanks so much.
Thanks so much, Akiva.
Well, Walmart is gearing up for another historic stock split. The largest U.S. retail investors will carry out a stock split on Friday in an effort to make shares more affordable for its employees. Let's bring in Brooke DePalma with the details. Brooke.
Good morning, Kiko. That's right. For the 12th time in 50 years, Walmart will be conducting this stock split. Now, the last time this happened, well, it's been quite a while. The last 2-for-1 stock split happened in April of 1999, and this will be the first 3-for-1 stock split. And so here's how it works. Shares will be issued after market close on Friday, February 23rd, but investors need to know that they must own shares at close of business today on Thursday, February 22nd. Then on Monday, February 26th, at market open, Walmart will begin trading on a post-split basis. Now, other things worth noting is that this will increase the number of shares of Walmart's outstanding common stock to 8.1 billion. That's up from 2.7 billion. And it's important to note, while the stock will trade at a lower price, it will not change the underlying value of investments within the Walmart company. Very important to note that there. And it's important also to note that investors have to understand the fundamentals of the company before they jump in. There's been a lot of buzz about this.
So then, Brooke, with that in mind, and being that we're still in the thick of earnings season and some uncertainty still ahead in terms of the consumer, why now? Why have this 3-for-1 stock split now?
Yeah, well, Walmart CEO Doug McMillon really trying to frame this as a way for all employees to jump in and buy shares of the company, kind of giving a nod to their founder, Sam Walton, who always wanted to write a story where employees really felt like they were a part of this bigger, grand story of the robust Walmart that is. And so they're really looking to say that we're all in this together, and that was the secret that Sam Walton kept very close. Now, analysts do see this as a positive catalyst, really looking at that positive growth story that Walmart's trying to put out there. But in addition to that, as we see with all stock splits, it's important to note that this is simply a cosmetic play here. One director from Babson College even telling Yahoo Finance that a stock split is simply an accounting gimmick even. But she did want to note that there are 3 reasons behind this decision. First, as I noted before, this really does signal a sign of confidence in the future of Walmart's growth story. We know that they really are ramping up growth as of late and most recently announced at their last annual meeting. Second, this brings down the stock price to a more preferred trading range. Once again, Walmart really trying to get in all employees to buy shares. And lastly, we also shared that this is jumping from roughly 2 billion to 8 billion outstanding common stock shares. And so really the third reason here is liquidity, with more shares trading, even though it is the same dollar amount that's trading. And we can't emphasize enough, if you're looking to jump in now, be sure that you understand research and really do understand the fundamentals of the Walmart company before you buy into this hype.
Okay, good morning there. Brooke DePalma, as always, thanks so much. Well, coming up, we're in the middle of tax filing season. What should you do with your tax refund? We're going to discuss after the break.
Travel is poised for a comeback. Wait, wasn't that last year? Well, we're poised to go into overdrive at least. High ticket prices, dwindling savings, and all that recession talk didn't slow red-hot demand for planes, trains, and leisure spending across the board. Air travel, for one, rocketed back towards that all-important pre-pandemic level with no signs of slowing down in 2024. But with a new year comes new challenges. Will all that pent-up demand finally get tapped out? Will passengers finally get priced out? And will much publicized issues for giants like Boeing put a crimp on demand? And then there's the mighty seas, of course, the likes of Carnival and Royal Caribbean. They were on cruise control last year. The sector was the outperformer, but will operators increase rates for those still riding the post-pandemic fervor? Don't discount geopolitical risks either. Their impact on the price of fuel. Oh, and a host of new trends from astro to music tourism. Yes, we're talking Taylor Swift. There's lots to digest, but Yahoo Finance will tell you exactly what you need to know. Tune in to Yahoo Finance's Travel Guide 2024 Industry Insights beginning February 26th.
Nearly 70% of Americans say their tax return is important to maintaining their financial security this year. That's according to data from Self Financial. So what can consumers do with their tax returns to build wealth? Let's bring in Monique White, Self Financial Head of Community, to discuss more. Good to have you on the show here. Important to note that for a lot of people, they're saying, oh, we want to get my tax refund, I'm going to splash out on this. But this is also an opportunity to build wealth. What are the top 3 strategies people can use to use their returns to build wealth?
Yeah, so if you are expecting a return and you're looking for ways to optimize your refund, there are a few things that you can do, big 3. The first is to save. So building an emergency savings is extremely important in making sure you can cover that whenever it comes up. The rule of thumb is that you should save at least 3 months of your living expenses, but we know that that's tough for a lot of Americans. So try to put away something from your refund just to cover a small emergency. The next is to manage your debt. Catch up on any late payments. Try to pay down your balances so that you're not paying too much on interest fees. And the next is to prioritize your credit. I personally think credit is a topic that's overlooked a lot of times, and credit is just way too important to do that. You need credit to rent an apartment, to qualify for better interest rates or certain loan products. So taking your refund and investing in your credit, Self offers multiple products that fits into your budget at different multiple price points so that you can confidently build your credit.
You talk about, building your credit, paying down debt. I wonder, when you look at how this particular refund's used, how many Americans are relying on that specifically at the end of the fiscal year?
Yeah, we know that 100 million people in the US have subprime credit. And what that's telling me is that they're using credit to supplement their income. And that's why their credit card has gone down. So we know people are struggling financially right now because of inflation. We just exited our holiday season, so credit card debt is up right now. Student loan payments resume, and 70% of our customers feel like they need their refund to maintain their financial security, and 37% of Self customers have said they're using their refund to pay their bills.
And in terms of, if you do have a big refund, that's usually a sign that perhaps you've not allocated things properly when you're sort of having your looking throughout the year. What should people do throughout the year so that they actually can use some of their paycheck and their income during the year when they need it, so that they don't then have to rely on their tax returns as part of their emergency fund?
Yeah, that's a great question. I'm no tax professional, but, if you are living paycheck to paycheck, you're struggling with your monthly essentials and managing your debt, what that tells me is that every dollar counts. So it may be a good time to take a look at your W-4 and adjust your holdings so that you can have more money up front to manage those things.
And so in terms of the people who are using their returns to pay down emergencies that might come up, how much financial pressure are they under now, say, versus in previous years, now that we have sort of a better gauge of where we are? A lot of that pandemic money has also run out.
Yeah, so last year, at the end of last year, we surveyed our customers, and 65% of our customers felt like they felt more financial pressure this year than last year. And that just goes back to every dollar counting. In our recent survey, we also found that 29% of our customers will be using their tax refund specifically just for catching up.
Goodness. Well, if there's any major takeaway that you can get from this, certainly make sure that you seek some financial advice when you get that return. Certainly don't blow it all. Use it as a chance to build some wealth. Appreciate you taking the time to join us. Monique White, Self-Financial Head of Community. Thank you so much.
Thank you.
All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at green across the board here. Currently looking at the Dow up more than 250 points. Also looking at the S&P 500 charging ahead there, up 80 points or just about 1.6%. And of course, the tech-heavy Nasdaq lifting all boats across the board here. And as we mentioned internationally as well, looking at the Nasdaq up 363 points or 2.33%. No surprise that Nvidia still our top trending ticker, as really a proxy of AI demand. And as we discussed, the ability for some of these other tech companies who are enjoying the windfall from that. Obviously still early days, as we mentioned, in the generative AI story and the windfall, but at least continuing for now to lift all boats. All right, well, that does it for now. I'm Rochelle Akutho alongside Akiko Fujita. Stay with us on Yahoo Finance.